labor market's in a bit of a holding pattern.
Demand for labor has actually slowed quite significantly.
The estimates are rather tight. There's a very tight range of estimates.
If we see any type of weakness in the labor market, that's what the Fed is going to be looking at.
It's the labor market that matters most.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. This is Bloomberg Surveillance. Welcome back. It's Payrolls Friday, but first, a not so beautiful breakup.
And I've helped Elon a lot. Elon and I had a great relationship. I don't know if it went well anymore. I was surprised because you were here. Everybody in this room practically was here as we had a wonderful send-off. He said wonderful things about me.
Is turning positive on signs the feud between Elon Musk and President Trump does appear to be easing. The psychology of the White House once again dominating Wall Street discussions with China-U.S. trade talks in focus, sort of, after a Xi Trump phone call for about 5 minutes. But at least in one moment, all eyes will be on the U.S. payrolls report due at 8:30 a.m. We would be talking about Payrolls Friday. We might have been talking about what happened between Xi Jinping and President Trump. We might have been talking about the bill or even the fact that President Trump had been talking to Vladimir Putin of Russia. But we are not. We are talking about a spat between two one-time besties.
Absolutely. Spectacular display of events yesterday. This friendship unraveling, imploding between the president and the richest man in the world, his once first buddy, the individual that was supposed to cut all this government spending. It started about the big, beautiful bill. And it even then became very personal, going into things like Elon Musk insinuating that the reason why the Epstein files aren't released is because the president is in them. And then the president coming out and saying, you want to see government spending cut? Maybe I'll pull back on your contracts. It was on and on for hours. Today, there's a little bit of a détente. We have political report that the White House is going to be scheduling a call, I just think with aides and Elon Musk, but potentially that's why we see Tesla shares actually getting a little bit of reprieve this morning.
And we'll get into the amount of money that's being involved in some of these. The fact that you saw $150 billion of market cap wiped off Tesla in one day, whipsawing the entire broader U.S. index. But there's a broader point here. And I think it's really important on Payrolls Friday to consider the fact that investors have no idea where they should look. And this is important, this idea of, is it the real economy? Is it the question of the future of trade? Or is it personal scuffles between the president and specific leaders of major companies? It raises a specter of uncertainty anew that really has not been in the equation before this era.
Luke Kawa yesterday took to Twitter when all this was going down and saying this is feeling EM-y, like an emerging market economy when you see the president of the United States having this open feud with the CEO of Tesla. What I would say is that in Washington, D.C., no one is exactly surprised about this blow-up. People have just been taking wagers behind the scenes on when this would happen, when these two individuals might explode and be head-to-head with each other. I think going forward, though, it does show what kind of basically vulnerability you could be in a CEO if you take the opposite end of this administration, whether it comes to policy or legislation in Congress.
This won't be the Elon Musk versus Donald Trump hour or 3 hours. This is going to be a discussion about Xi Jinping as well and what's going on with China. And of course, payrolls, which do arrive in about 2.5 hours. The estimate in the Bloomberg Economic Survey is 126,000. The range is across the board from 190 down to 76. Coming up this hour, as we look at futures that are trying to figure out, can they claw back some gains after what we saw yesterday? Julian Emanuel of Evercore on the latest market swings. Ed Mills of Raymond James as the U.S. and China agree to more trade talks. And Dan Ives of Wedbush eating popcorn in his bright suit on the fallout from President Trump and Elon Musk's breakup. We begin this hour with stocks climbing again as investors await payrolls due out later this morning. Julian Emanuel of Evercore writing, with this degree of uncertainty, we think the S&P 500 is ripe for, at a minimum, a stalling out of the rally within a bull market that will make new all-time highs in due time, but likely not until 2026. Julian joins us now. Julian, welcome.
Good morning.
So you're head on straight after the past 24 hours.
All you can do is chuckle, really.
Well, is that true? I mean, honestly, this is actually a really big question mark. Is it just eat popcorn and watch something that, as Annmarie said, was inevitable and wait for it to blow over before you continue? Or is this a new type of risk that any high-profile CEO is increasingly in the hot seat if they say something that seems at odds with the current presidential policy?
Well, the risk from a corporate perspective is there. We know that social media is very powerful, and there are consequences in things that one says or does not say. But the bigger question is, as an investor, how do you deal with this? And what we're saying is, what you really have to do is sort of barbell your horizons. Because if you look at yesterday, okay, when the tweets started, obviously first Tesla started falling, and then it infected the rest of the market, particularly a lot of the larger cap stocks. And then, of course, this morning we've bounced back. Great in a bull market. There's lots of trading opportunities. But what you also have to do is, if you're thinking long term, you really have to think long term. Just set the noise aside, but increasingly more difficult to do.
War yesterday, potentially peace between these two today. Do you just buy the dip yesterday when you see Tesla shares down, I believe, at 1.18%?
Well, again, the market has been in mode now for the last several weeks where all the dips are getting bought. Our view here, again, is that when you see the degree of the reaction on a day like yesterday, it's telling you that it's becoming increasingly more of a challenge and that we're getting to the point, and frankly, we're going to see, perhaps in the payrolls report this morning and then next week's inflation data, news that may not be quite as favorable as it's been. So we think there's likely a transition coming here where the market is going to need good news to continue moving higher, and it may be mixed.
Is there a jobs number today that gets people off of staring at their screens, waiting for the next tweet or truth to drop between this feud between the president and Elon Musk?
I would bracket it sort of below 100,000, which will be a bad news is bad news response. Because if we look at the last couple of days, it hasn't been clear that lower yields are a positive for the market. And we think, again, under 100,000 will bring home the fact that, yes, all this economic uncertainty is starting to have consequences, even if they are minor and even if they are slow in developing. Conversely, over 150 would be a major, surprise and argue for a test of 6,000 on the index.
To build on what AMH is talking about, this idea of looking long term. How do you do that when there is such a huge question mark around the trajectory of the U.S. economy and, frankly, where we are globally? There has been discussions about whether we are heading to a lower inflation kind of period of time versus the pandemic, but that is pocked by also, just tepid growth. This idea of, yes, we have inflation, but also lower growth profile. Are we looking at possibly gangbusters growth, as the administration is talking about? How do you even gauge that at a time where the data is messy? And it's very hard to get people to look more than just the next couple of hours ahead of them.
So all of that involves sort of scenario modeling, but let's set that aside. As a long-term investor, you really want to stay overweight the names and themes that have secular earnings growth power. And, we've been on enough in these last 2 years, and you'll hear it again, AI-centric names and themes. If you think about it, right, and this is sort of the proof in the pudding that what we saw from the February peak to the April trough was a cyclical bear market within the aspect of a structural bull market, is that the same names that were leading into the peak also got hurt the biggest and frankly have been leading. And look, unspoken, undiscussed was the fact that in all of yesterday's noise, the biggest software company in the world made a new all-time high yesterday.
Well, and this actually does speak to the question of NVIDIA and its relationship globally versus the relationship in the United States. And I know you're talking also about Broadcom and some other companies that have come out, but it raises this question about the connection between the U.S. and China. It raises the question about whether these tech companies can be global tech companies or whether they can be domestic tech companies at a time when there's a lack of clarity around what the ultimate destination between the U.S. and China actually is. How much is that relevant? How much should that have been the main story today? All things being equal, given the fact that Xi Jinping and Donald Trump did have an hour-and-a-half phone call and hashed through a whole host of things and have planned a visit for Donald Trump in Beijing.
I don't know, but when you think about the totality of all that, if you're mayors, you're probably happy that all this stuff happened around him.
Absolutely.
Because his meeting was quite uneventful. But in reality, again, it's the sum of the complication of the picture. But with the backdrop that we know two things, right? We know that the demographics globally are slowing. We know that is going to cause, upward pressure long-term on wages, X of, the ups and downs of sort of a near to medium-term economic cycle. And that means that the AI race is on. And think about it, right? You had the DeepSeek moment, the stock sold off, but none of the companies pulled back their CapEx spending plans. And then, lo and behold, the president goes to the Middle East and becomes, the single greatest salesman for the AI revolution that we've seen. So it really points to the fact that this is an inexorable long-term trend.
Is it a long-term trend, even if China is not part of the equation?
Yeah, it absolutely has to be. It goes back to the demographics, and if you think about it, is what we're seeing this year in particular is that it's starting to apply. We were worried that there weren't going to be adoption and applications across industry, and you think of an industry like healthcare, where the cost structure is still incredibly inefficient in the U.S. We're starting to use AI to rationalize that business. And when you think about the challenges inherent in balancing the budget or getting the big, beautiful bill done, you think about a place like that where it's going to be really necessary to figure out how to get costs under control.
Julian, Emanuel, you get to sit with us this entire hour and try to make sense of all of these different headlines, and we are wonderfully grateful to you for that. Julian Emanuel of Evercore sticking with us for the hour. Right now, let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Yahira Anna and Yahira.
Hi, Lisa. We start with the big story of the day. Elon Musk is signaling he's ready for a cooling off period with President Trump after their public feud yesterday. Tesla shares plunged yesterday as Musk called for Trump's impeachment and threatened to decommission the SpaceX Dragon program. That after Trump said he would cancel Musk's federal contracts over criticism of his tax bill. Musk posted this morning he's ready to take a step back and won't decommission Dragon. Meanwhile, Trump getting along better with Chinese President Xi Jinping. After a 90-minute phone call yesterday, the two agreed to additional trade talks. Trump acknowledged their relationship had gone off track, but says it's now in good shape with trade talks set to happen shortly. And a check on shares of Lululemon. They are down nearly 21% in the pre-market. The company posted a second straight quarter of disappointing results with projected sales and profit below estimates. Lulu blaming rising competition and tariffs and said it does plan to raise prices on some items to offset the impact of new levies. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. We'll be talking more about Lululemon in just a little bit. A question about execution versus macroeconomics. Up next, back on track with China.
I think we're in very good shape with China and the trade deal. We have a deal with China, as you know, but we were straightening out some of the points, having to do mostly with rare earth, magnets, and some other things.
Ed Mills of Raymond James joining next. This is Bloomberg Surveillance. Futures snapping back, looking for a weekly gain after yesterday's turmoil that stemmed from a feud between Donald Trump and Elon Musk. Today, a bit of a reprieve from that, up 0.4% on the S&P and NASDAQ. Russell 2000 doing better than that, up 0.5%, as people look to potentially something of a détente between the U.S. and China. Under surveillance this morning, back on track with China.
I think we're in very good shape with China and the trade deal. We have a deal with China, as you know, but we were straightening out some of the points, having to do mostly with rare earth, magnets, and some other things. He invited me to China, and I invited him here. We both accepted. So I'll be going there with the First Lady at a certain point, and he'll be coming here, hopefully, with the First Lady of China.
Here's the latest. President Trump and Chinese leader Xi agreeing to more trade talks during a phone call yesterday. Trump saying Treasury Secretary Scott Bessent, Commerce Secretary Howard Lutnick, and Trade Representative Jamieson Greer will handle the negotiations shortly. Bloomberg's Tyler Kendall joins us now. Tyler, just can you tell us what led up to this phone call and what was accomplished in it in terms of both arranging another meeting as well as ratcheting down tensions in specific areas?
Yeah. Hey, Lisa. Good morning. Well, China says that this call was met on the invitation of President Trump. So he had wanted to have this phone call with Xi Jinping for a while. That tracks with the long-held position from this White House that they really felt that these tensions could be eased down if the leaders had direct contact, which doesn't necessarily go with our reporting when it comes to China's point of view, which is that they would have much preferred to have key advisors really iron out those details before putting Xi Jinping on the phone. And there were a lot of details to iron out. President Trump said that this phone call really centered on trade and suggested that they addressed one of the key sticking points for the U.S. when it comes to rare earth minerals. As you well know, the U.S. has been accusing Beijing in recent weeks of slow walking those critical and rare earth exports to the U.S. that are so essential to supply chains here. But in a statement after that call, China says that they have not violated any part of that agreement reached in Geneva when it comes to this. So it really does remain to be seen if we're going to see a speeding up of these export licenses, since it's not totally clear on exactly what the leaders did agree to, nor what President Trump offered, though, in the Oval Office. He did say that Chinese students would be welcomed in the U.S. amid heightened concerns from Beijing about the State Department's plans ultimately to revoke certain Chinese student visas. Lisa, as you well know, there's still a lot of issues that need to be addressed. And there was a pretty interesting split screen here in Washington yesterday as Commerce Secretary Howard Lutnick testified on Capitol Hill that he actually wants to see a tightening and more enforcement when it comes to some of those export controls that China has been concerned about.
Tyler Kendall, thank you so much. A split screen and triplets or maybe quadruplets, because it seems like the focus was all over the place. When does this guy sleep?
Well, exactly. The point is, this was really an incredible week in terms of meetings the president had. He had a meeting with the president of Russia, who's in the middle of a hot war for his invasion of Ukraine. This is the first time he has gotten on the phone as president with Xi Jinping, basically, since inauguration for an actual discussion on trade. You had the Chancellor of Germany, the biggest economy in Europe, in the Oval Office, and all of this completely overshadowed by this blow up between him and Elon Musk.
Joining us now is Ed Mills of Raymond James. Ed, I do want to start on the China and U.S. trade negotiation, just simply because maybe it has a bit longer legs. Maybe. We don't really know. I just am curious about your takeaways yesterday from what we know about that phone call and what we don't know.
Yeah, Lisa, I think it's so fascinating to see this focus on the rare earth minerals. The day after some of these restrictions came in from China, I got a phone call here at Raymond James and said, do you realize that we have about 6 months supply of this? And at the end of that, we can't make a missile. We can't build a car. We can't build an airplane. Our industrial capacity is permanently impaired if we do not have access to these rare earth and critical minerals. So China and Trump 2.0 know exactly where those choke points are, and they're using them, Lisa. And so because of that, I am optimistic that we ultimately get a deal, because we cannot sustain this. And I do think that longer term, we are going to see a lot more production here in the United States, and a lot of these trade deals look to get those rare earth and critical minerals from other sources from China. We had a Defense Production Act signing last week from Trump, where it says you can bypass a lot of the normal routes to make sure we can get that. And so focusing on that and realizing that that's important is where we get the deal. The final piece here is Lutnick getting added to the list of folks that will be in the next trade delegation. Lutnick's Commerce Department has been putting a lot of restrictions on semiconductors and other exports into China that China also really needs. So working on that, but I'm not quite sure that the Commerce Department, Lutnick, and the Trump administration is going to ease up on our restrictions. So China is going to be very tough on theirs.
Can we just stick for a second with the rare earths? Why do you think that actually there's going to be a loosening of these restrictions and the ability for the U.S. to get licenses, given the fact that the easing of the controls was not in the Chinese readout?
So I think because we need them, because there's not really another alternative. I do think that the United States is probably going to have to ease up on some of the things that we are doing. First and foremost, it was easing up on that 145% tariff rate. I think that China is going to be able to ask for more in some of these negotiations than I think that Trump expects. I do think that there's ultimately other sources of this globally. Rare earths are not actually all that rare. What is rare is where we are willing to extract them, where we're willing to refine them. But that is going to take years, Annmarie. So I do think that they are willing to provide that as long as the United States is willing to provide other things to China, such as some of the technology that we're restricting. But politically, that's a really tough thing.
With Commerce Secretary Howard Lutnick's inclusion now in the trade negotiations, and we're waiting for a time and place, do you think it's going to ease Beijing's ability to get a handle on these semiconductors, or actually potentially make it harder? Because he's quite hawkish.
Yeah, if I had to choose something, it's harder. What we are seeing is we've had a lot of conversations about IEEPA, this International Emergency Economic Powers Act, which has been used to put the tariffs globally, challenged by the courts. But look for IEEPA to be used next to further restrict a lot of technology that is going into China. Since that meeting in Geneva, there has been a worldwide ban on Huawei Ascend chips from being used from our allies. If they use that, that's a violation of U.S. export controls. We are going to see an uptick in other semi-cap equipment, EDA software, things that are important and critical on making semiconductors in China. All of those things have bipartisan support. And if you look to the Hill, they want the administration to go even further. Geolocation on any chip that goes into China to make sure that chips that shouldn't be going there do not go there, Annmarie.
Ed Mills of Raymond James, thank you so much for being with us this morning as we try to figure out which story has staying power for the next couple of hours. Interestingly, Michael Hartnett talking about how all of these things, of Bank of America, talking about how all of these potential restrictions are not being factored in right now to global markets, saying that global stocks are close to triggering a sell signal with fund inflows and market breadth both running too hot. Julian Emanuel of Evercore ISI is here. And I'm curious, you seem to agree, seeing that maybe it is a time for there to be some sort of breather.
So if you look at it, the Bloomberg Trade Uncertainty Index and the S&P 500 have literally been moving in inverse lockstep going back to February, actually. And clearly the rally in the stock market off the April low was contingent on some of the lessening of this tension. But at 23 times earnings, we are still extremely expensive in terms of valuation. And, you know, when you listen to that last discussion with Ed Mills, one cannot help but think that this is going to take a longer time to play out. You're not going to have headline gratification from subsequent China-U.S. meetings like you did in Geneva.
Just to put a bow on that, does that mean that big tech is the most susceptible to potential ratcheting up of tensions once again between the U.S. and China?
Well, look, and again, to our thesis, you always have to deal with more volatility in big tech, period. That comes with the territory of higher multiple secular grower stocks, which have been embraced over the course of time. But obviously, you know, it is ground zero for where the political conflicts are going to lie.
Yeah, and we don't really understand exactly what the ultimate goal is, Annmarie, of what the U.S.-China relationship looks like, especially when it comes to tech.
But we do know what the choke points are. China wants access to these advanced semiconductors that the United States has export controls on, and the U.S. needs these magnets and rare earths. And I think Ed Mills really displayed that, obviously. The issue is the timing of this. Phase 1 trade deal started 2018 and ended in 2020. This isn't going to be done in just a few months.
Well, up next, this might be done in just a few hours. President Trump and Elon Musk's bad breakup. Tesla bull Dan Ives joining us next. He's got quite a bit to say. This is Bloomberg Surveillance. futures positive this morning after the turmoil yesterday that sent both stocks up in response to cooling tensions between the U.S. and China, and then down between heating up tensions between Donald Trump and Elon Musk. Right now, we are up. NASDAQ futures up about 0.5%. Russell 2000 up 0.6%. 3 hours away from the cash open. Here are your morning movers with Yahira Anna and Yahira.
Hi, Lisa. We start with Tesla bouncing back up nearly 5% as signs emerge of a possible thawing in Elon Musk's strained relationship with President Trump, which, as we know, was on full display yesterday. But in a series of posts on X, Musk seems open to de-escalating. We also have that political reporting that White House aides have scheduled a call with Musk. I look forward to what your next guest, Mr. Ives, has to say about all of this. Meanwhile, we have shares of Broadcom. Those are falling 3% after the chip giant gave a revenue forecast that failed to live up to the hype. That's because it came in just a touch higher than estimates, but expectations were sky high heading into the report, with the stock up nearly 80% since an April low. But it's not AI-related demand that is the problem. That jumped 46%. CEO Hock Tan says the problem is demand outside of AI is still sluggish. And we end with Lululemon, those shares still cratering more than 20% after it issued another weak quarter and a gloomy outlook because it says tariffs will hit profitability. And if you thought your Lululemon leggings couldn't get any pricier, well, they're planning price hikes in order to offset those costs. But that, of course, could backfire as U.S. shoppers continue to pull back at their stores. Lisa?
Thank you so much, Yahira. Annmarie, do you think that you'd spend $200 on a pair of leggings?
If I really loved them, but I think there's been more exciting brands than Lululemon. I think that then they're going to blame it on tariffs.
That might be part of the issue. We'll get into that in just a second. On our radar this morning, Elon Musk signaling he's willing to cool tensions with President Trump after their very public feud. This after Tesla shares fell 14% and Musk suffered a $34 billion loss to his personal net worth. You couldn't take your eyes away. A real question of who has more to lose in this fallout.
Well, I think yesterday you saw Elon Musk had a lot more to lose in terms of Tesla shares down at 1.18%. He lost millions of dollars when it comes to his personal wealth. At the same time, the President of the United States and I think members of Congress know how influential he is. You know, the helm of Twitter and X, and also the fact that this is someone in the future, if you're looking at midterm elections, if you're looking at 2028, someone in the future that could actually be a source of political campaign donations. So I think it depends who you are in Washington, D.C. I think we'll have to see how far the feud goes and whether or not this phone call the White House aides have set up will actually work.
Julian, before we were talking about the premium in being close to President Trump. Is it now a liability or an advantage to have that kind of close relationship with President Trump at a time where it could bestow you with quite a few favors, but also could sour and turn the opposite direction?
I think it's a case-by-case basis, and it really depends on how big the other person's megaphone is and how they wish to use it. And you know, when you look at it, the problem here, among the number of problems, is that you're basically coming out, and the big beautiful bill is the nexus of the controversy, and that's the thing that has to get through, because as much as we are averse to having the deficit expand, the alternative, a debt default, is, failure is not an option territory.
Julian is trying to focus on the things outside of this drama, which a lot of people market are President Trump and Chinese President Xi agreeing to more talks on tariffs and rare earths, among those things that are happening elsewhere. Trump saying the negotiations would occur shortly at a location to be determined. More questions than answers, perhaps. But Annmarie, markets took a positive signal from this discussion.
Well, it was the first known phone call we've seen the contact since Trump took office, and Trump has been teasing out this fact that he wants to get on the phone with Xi Jinping, and he finally was able to do it. The two choke points that Ed Mills talked about are really seen here. The rare earths the United States needs, but also this idea that Secretary Howard Lutnick is now going to be part of the fold, coming into these conversations. What does this mean for China's ability to access semiconductors? Are we going to see a ratcheting up of export controls or an easing of export controls? And if anyone thinks this is going to be done in just the next meeting, which we don't know the time and place yet, I think, hold on to your hat, because when Trump won, phase one, which was a purchase agreement, just a purchase agreement, took years.
This is one reason why people are looking at the big, beautiful bill down in Washington, D.C. instead, because that maybe is something more tangible and that has a deadline. The SALT cap, one of the focuses of this particular bill, and it is under threat. Sources telling us here at Bloomberg that President Trump is open to scaling back the SALT cap, a major threat to his one big, beautiful tax bill.
I am crossing the Grand Canyon on a piece of dental floss, okay? The equilibrium that we reached here took quite a bit of time to get to where we are. And you can't load me up on either side. And if you go and slash the SALT cap that we negotiated carefully for over a year, it's going to make it very difficult for me to deliver the necessary number of votes.
Julian, just quickly, I'm curious how closely you're watching these negotiations and what particularly stands out to you that you want to see either remain in or get taken out of this one big, beautiful bill.
Well, first of all, the imagery of crossing the Grand Canyon on a piece of dental floss, it just tells you how difficult this is. And it's not just, Speaker Johnson is worried about the interplay between the House and the Senate, which is something we really only have to worry about very infrequently. And it just points again to the difficulty of getting this and the fact that and Trump himself, as I probably quote in The Art of the Deal, is that the best deals are when nobody is fully happy, and we have to accept that we have to get to a place where nobody's going to be fully happy.
Well, talking about nobody being fully happy, Elon Musk signaling he's open to cooling tensions with President Trump after the disagreements boiled over into an all-out public feud.
I'm very disappointed in Elon. I've helped Elon a lot. Elon and I had a great relationship. I don't know if we're well anymore. People leave my administration and they love us. And then at some point they miss it so badly, and some of them actually become hostile. I don't know what it is. It's sort of Trump derangement syndrome, I guess they call it.
The back and forth sending Tesla shares plunging. Its market cap seeing its biggest one-day drop on record. Dan Ives of Wedbush writing, this view does not change our bullish view of Tesla and the autonomous view, but clearly does put a fly in the ointment of the Trump regulatory framework going forward. Dan joins us now. Dan, great to see you.
Great to be here.
Very curious to hear what you have to say about this. The fact that you do not change your bullish outlook on Tesla, even though it seems like there is a massive key man risk. Please explain how you dismiss that.
Look, I mean, this is it's like a frenemies in junior high school that's essentially going on between Trump and Musk.
Who are billionaires and leaders of massive empires.
And look, the reality is that our view is that this is something where the friendship it doesn't end. In other words, I still believe that this will be resolved potentially by the end of the day or by the weekend. And it's not our view that this changes the regulatory landscape for Musk when it comes to autonomous and the broader vision.
How do we even talk about the fundamental backdrop, though, when you have a war of words whipsawing this company by more than $150 billion of market capitalization? Does that introduce a risk that a lot of institutions just won't take?
Look, but we always talk, and we've talked about it on the show for decades. It comes down like with Tesla. That's the reality. I mean, you're going to have the volatility. It's part of what we've seen with Musk. But in our view is that you have to sort of see through the noise, understand the autonomous vision. It's our view, ultimately, Waymo's at the kids' table when it comes to autonomous and the AI future. And look, it's Rod Serling. It's an episode out of The Twilight Zone yesterday. I mean, in my opinion, in all my years covering Tesla, it might win the prize. Top 3, maybe top 1, for one of the strangest days that I've ever seen.
So last year, Elon Musk said, take away the subsidies, it'll only help Tesla. Why does he, or based on reporting out of the Speaker Johnson, out of President Trump, why has there been this reversal from him regarding the EV subsidies?
He's no longer in the White House. I mean, and you've talked about it. It comes down to like he's now trying to distance himself for a few reasons. One, that would hurt Tesla, not as much as the others in terms of the Detroit Big Three. But then you also look at what's happening here. I believe there's some poker going on as well, is that he's trying to distance himself from Trump because of China, because he also needs to play nice in the sandbox in Beijing with everything that we see as given the China market, raw materials, how important that is from a demand perspective. He's trying to be sort of, I think, balances. And for Musk, even though some of it could come out sort of spur of the moment, I do believe potentially there's a longer game here.
Is he rebranding for a midterm election where most people think the Republicans are going to get an absolute shellacking?
Well, look, and the reality is that that's why in D.C., I mean, you know, if you're a hater or lover of Musk, he is going to be a huge player. And that's why for all parties, that's why White House, you know, it seems trying to put together this phone call, because no one's a winner, Trump or Musk, in this frenemies battle. I think it's two kids in the sandbox. I do think the play date will be back on at one point. It's just going through definitely some little tension here.
Wait, you're actually suggesting something that's pretty important, that there is an aspect of deliberateness to this by Elon Musk to revive the brand around Tesla, to try to paint it with a less MAGA type of brush after a lot of blowback and a lot of fall off in sales, particularly outside of the United States. Do you really think that actually this is a vocal way of his distancing himself and that he can get back in good with President Trump, but this is an effort to revive a brand that suffered a black eye, just like Elon Musk?
Look, I think there's some of that potentially at play, but you don't burn the house down just so you can meet the firefighters. I mean, the point is you need to navigate the situation very carefully. You need Trump as a friend, not a foe. And that's why Tesla down so much, is because of the fear on the regulatory. It's going to be a green light for when it comes to autonomous, and especially Tesla. You know, I view as a huge advantage there. You could say Waymo little as well. You don't need Trump now as an enemy. You need him as a friend. Hopefully by the end of the day, the candlelight dinner's back on. I just do not believe that these friends become enemies. It's a frenemies junior high school situation between two, as we know, very stubborn individuals.
Let's say in episode 6, they still haven't gotten back together. Do you change your view and become more bearish on Tesla?
Look, if this continues to play out longer and longer term, obviously that would be a huge negative. But my view, just like junior high school, they will get back together as friends. But it's going to take some intermediaries. That's why the White House, there's a lot in D.C. on the Republican Party and everywhere.
Well, the distance is already there. And there's some things that happened yesterday that potentially the White House are really upset with and maybe are going to create a lot of tension for a long term, even if they start playing a little bit nicer. Is this an opportunity potentially for China to use BYD? Are we going to see BYD cars made in the United States?
Look, I think this is just a broader game of poker going on. And Musk and Trump are key players at that poker baccarat table, however you want to think about it. China definitely is watching this carefully, because also remember, Musk is, I'd say along with Cook, I mean, know the China market better. They also play nice in Beijing as well. So there is some balance going on here. But look, Musk, we want him to distance himself from Trump, still be a friend. It's been a very strange few weeks, few months, and obviously a lot, 24 hours. But I do believe by the end of the day and going into the weekend, I don't expect this to get worse. I do believe this will start to be cooler heads prevail. And that's why Tesla stock will be up there. I think Tesla is way oversold. Like, unless you think draconian, this goes into like a dark period, to me, I think we view this as an opportunity.
So, Dan, let's get back to the American consumer for a second. So what I hear you saying is you're assuming that Elon is not going to form a third political party, which I think we can all say we're relieved about. Has what's happened caused a measure of irreversible damage? And if not, how long is it going to take for the American consumer to disentangle him or herself from the politics of all of it?
And first, I'm disappointed in you. I thought we were matching today, but I'm not going to hold that against.
Sartorial splendor, I can't even come close.
But it's fine. I'll look past it. Look, I don't view that as, I think it's something, there is brand damage, and there is things that Musk needs to turn around in terms of U.S. We said 5, 7, potentially 10% brand damage. The American consumer, look, I think there's confusion when it comes to Musk, who's obviously alienated many in the Democratic Party, now you're actually alienating the Republican. So now it's like, if you want to alienate everyone, you've actually done a great job. Okay, so now it's the point, like, okay, how do we sort of build this back? Does the board get involved? Because again, it goes back to, like, the board needs, I think in a situation like this, they do need to play a hand in some way to make sure that this doesn't go off the rails.
If it's a junior high school situation, then there needs to be an adult in the room.
You need an adult in the room. You need an adult in the room at the prom.
Yeah, come on. Get home. It's your curfew. Dan Ives of Wedbush, thank you so much with your sartorial splendor. Julian, I love that phrase. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahaira Anand. Yahaira.
Hi, Lisa. The U.S. Treasury has called on the Bank of Japan to raise interest rates to strengthen the yen in its semi-annual currency report. That is likely to support market speculation for the BOJ to raise borrowing costs again later this year. The BOJ holds its next policy meeting on June 16th and 17th. Meanwhile, Nippon Steel and U.S. Steel are on track to finalize their $14.1 billion merger ahead of a June 18th deadline. Sources telling us here at Bloomberg that talks between the two companies and the U.S. government are ongoing as the companies and their investors await final terms. The deal will clear Japan's Nippon Steel to own U.S. Steel with measures of American control. And Harvard University won a temporary reprieve from President Trump's ban on its international students entering the U.S., marking a legal setback for the administration in its fight with the school. The judge granted a temporary restraining order saying Harvard would face immediate and irreparable injury if the administration's proclamation went into effect. The next hearing is on June 16th. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahaira. Up next, the labor market's uneasy equilibrium.
We also expect a deceleration in the pace of employment growth this year. We have this uneasy equilibrium in the labor market where firms are not hiring. Demand for labor has actually slowed quite significantly, but they're not firing either.
Sarah House of Wells Fargo joins us next because that's right, it is Payrolls Friday. You might have forgotten. This is Bloomberg Surveillance. On the week's gains this morning, heading into the open with a bit of a lift pretty much across the board. You're seeing 0.4% gain on S&P, on NASDAQ, Russell 2000 up 0.5%, a bid into bonds. This has been a story for the remainder of this week as we get some sense that maybe globally there is going to be a response by central banks in Japan in particular. 30-year yields, once hovering near 5%, now 4.87. Under surveillance this morning, the labor market's uneasy equilibrium.
We also expect a deceleration in the pace of employment growth this year. I think that's been quite well telegraphed because we have this uneasy equilibrium in the labor market where firms are not hiring. Demand for labor has actually slowed quite significantly, but they're not firing either. Companies are very cautious about talent.
Here's the latest. Investors counting down to May payrolls out in under 2 hours. Bloomberg survey forecasting 126,000 jobs added and unemployment to hold steady. Sarah House of Wells Fargo writing, we suspect it will show the cloudier outlook starting to weigh on hiring, with payroll growth moderating to 125,000 in May. Sarah joins us now. Sarah, thank you so much for being with us. We almost forgot that it is Payrolls Friday. I'm curious about how we understand this number of 125,000 in an environment that a number of people have said is just going to be a lower number kind of reality with lower churn, but that's okay.
Right. So I think this number really will reflect the fact that, yes, there's tremendous uncertainty hanging over the outlook, whether you're a business that's directly affected by some of the trade policy or maybe some other businesses that are just thinking about, well, what is going to be the end demand for my business if consumers are getting squeezed. But with that uncertainty, I think while businesses are being reluctant to hire, and we see that in a lot of the demand indicators for new workers, they're also still being pretty reluctant to fire. And so we still have, I think, think this kind of muddle along environment where you do see, I think, some moderate deceleration in hiring, just as you're not adding as many new. But until you see a big move up in layoffs, I think you can see the train stay on the tracks.
Sarah, I'm taking an unofficial poll today to find out what everyone thinks the number that we would have to see in the payrolls report to basically claw our eyes away from what is going on between this implosion between the president and Elon Musk. What do you think that number is?
Yeah, so I think something somewhere around 80,000. So when you look at estimates around what's the break-even rate where the Fed really starts to maybe get worried that you're seeing job growth slow to a point where you're going to see more upward pressure on the unemployment rate, most of those estimates probably center around 100,000, maybe a little bit lower. And we know that the supply side is slowing just given the pullback in immigration. We're not seeing as big a gains in labor force participation. So I think a sub-80 number is what would really get the Fed's attention and make them rethink maybe the timing in which they might have to dial back remaining restrictiveness a little bit more to help support the labor market and the broader growth outlook.
If we were to get a number that low, how soon do you think the Fed would be willing to cut?
Yeah, so I think June is, we're not going to see a move in June, but I think if you got a really weak number today, so maybe even worse than that, sub 80, let's call it sub 50, and that was backed up by a weak number for the June number that we get at the beginning of July. I mean, I think you could see July be a real possibility, but you do need to see those payroll numbers lurch lower. Now, that certainly can happen, and I think this is a pretty tumultuous environment, so you could see that, but I think, one weak jobs report isn't going to be enough, especially as you think that this period is really going to capture, I think, in some ways the peak degree of uncertainty and sort of the immediate caution that we saw coming out of the April 2nd tariff announcements. And so the fact that we have seen some the 90-day pause on China, there's still, I think, some hope that we'll get some deals coming here that I think you could see maybe some stabilization in the next jobs report. But it's really going to take, I think, 2 back-to-back week numbers for the Fed to be like, okay, this is really deteriorating in a meaningful way. This isn't just noise.
Sarah, just quickly here, how concerned are you about the low response rates to the NFP survey?
So we've seen those actually this year. They've steadied a little bit, but they're certainly lower than what we saw a couple years ago. I mean, the good thing with the payrolls number is that this is still a very large survey. So it's somewhere around 120,000 establishments. So it's still capturing a huge swath of the jobs market. But I think anything that clouds the data quality that we're getting right now at such a pivotal time in the economy, obviously not helpful.
Sarah House of Wells Fargo, thank you so much for being with us. Julian Emanuel of Evercore ISI, I'm curious what you think is going to be a sort of a real market-moving type of number, to Annmarie's point, that could potentially change the narrative about the U.S. economy.
Well, again, I think it's sort of bracketed. Probably Sarah's number of 80,000 would get people in the bad news is bad news. And then, of course, to the upside, no one is expecting a number sort of above 150,000. That would refocus us on the fact that we're about to have a big, beautiful bill that is going to expand the deficit. But I do want to just, one thing, what's interesting is that actually we come into June and the small cap investing space has been totally unloved and abandoned. And you are in a so bad it's good area for the Russell 2000. And a weak payrolls number counterintuitively works because basically, if you think about smaller companies, they are much more prone to having difficulties when the labor market is as tight as it's been for the last 2 years. And then, of course, from the aspect of small caps, you don't have single stock tweet risk that you do in the larger cap brethren. So we think small caps are an opportunity this month.
Julian Emanuel of Evercore ISI, thank you so much. A really interesting call there, the idea that so bad it's good because ultimately it'll make it easier for them to hire people.
Although I would say never. You never know if a small cap CEO can potentially come in the crosshairs of this administration, given what we've seen play out in the last 24 hours.
Coming up next, we'll parse through what to focus on this morning. It is Payrolls Friday. Good morning. Priya Misra of JPMorgan, former NEC Deputy Director Everett, Eissenstat, and how to understand the China-U.S. Back and forth. Bloomberg's Ed Ludlow on the Real Housewives of the White House and Sarah Wolfe of Morgan Stanley. All that coming up. This is Bloomberg Surveillance.
The market's in a bit of a holding pattern.
Demand for labor has actually slowed quite significantly.
The estimates are rather tight. There's a very tight range of estimates.
If we see any type of weakness in the labor market, that's what the Fed is going to be looking at.
It's the labor market that matters most.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome back to Bloomberg Surveillance. It should have been Payrolls Friday. Instead, we're gauging the fallout in a war of words between President Donald Trump and his ex-first buddy, Elon Musk, the psychology of a breakup. Meanwhile, China-U.S. trade talks in focus after a Xi-Trump call. It's Payrolls Friday, and Annmarie, we are all very distracted.
Very distracted, which is why I keep having this unofficial poll on the show, trying to find out from analysts, from guests, what is a number we could see in the payrolls that would distract us all from the feud that was taking place yesterday and potentially will bleed in today, or maybe there'll be a fragile truce today. When it comes to Sarah House and Julian Emanuel, sub 80 or north of 150 is the print that we may need to see in order to be distracted with something else besides this implosion of a relationship between the former first buddy and President Trump. With this time last week, there was that huge goodbye party for Elon Musk. How quickly things change in Washington.
Aside from the drama, it's important to take a step back and to understand that we're talking about massive swings in huge benchmark indexes of the United States on the heels of tweets and recriminations, and it raises a question about the risk premia assigned to certain stocks, certain asset classes on the heels of new policy volatility. And that has to be part of the conversation. If it isn't going to be the economic data, is it going to be discussions about the bill, or is it going to be something else that keeps driving people with this idea that maybe there is another risk that you cannot quantify?
Well, I think yesterday when the president put out a tweet saying the easiest way to save money in our budget is to terminate Elon's government subsidies and contracts. This just reminds you, if you're an executive, if you're a company, that you are potentially one social media post away from seeing your stock fall and end the day down some 14%, losing $34 billion of your personal wealth because of a flare-up you have with the Oval Office.
So all of this type of noise, how does it really play back to the consumer, and whether there is going to be purchasing power and ongoing willingness to commit, let alone companies, their ability to commit to big investment plans as well as hiring plans? And that ultimately is the question that investors are looking for. How much is this going to matter to the real economy, which is going to have longer legs than potentially the emotions of two people who have a lot of power? And we should mention this. We're talking about them as children or real housewives, but the reality is these are people with an immense amount of power and responsibility who do have a lot of clout.
Yeah, they have a tremendous amount of clout. The most powerful man in the world with the richest man in the world coming head to head over a number of issues. This could be over what happened with the head of NASA that the president pulled out that was a friend of Elon Musk that he supported. Is it really about EV tax credits? Is it really about the deficit? It really doesn't matter. Julian Emanuel is saying you have to take a long-term view because the volatility day in, day out is here to stay.
Right now, the long-term view seems to be all distilled down into some positivity for the U.S. economy. Looks like we're going to end the week with gains, although fading from earlier highs across the board, up more than 0.3%. You could see in the bond market, we have had a bid into bonds. Possibly one of the drivers of some ease in markets is that it hasn't been the deficit discussion, but rather this bid back into bonds globally, as there does appear to be a disinflationary feel. Coming up this hour, don't miss this. Priya, Misra of JPMorgan as stocks look to rebound and signs of cooling tensions between Trump and Musk. Former NEC Deputy Director Everett Eissenstat as U.S.-China trade talks pick up, and Sarah Wolfe of Morgan Stanley counting down to that payrolls report in about 90 minutes' time. We begin this hour with stocks rising ahead of key jobs data. Priya, Misra of JPMorgan writing uncertainty remains very high. While the worst-case scenario has been taken off the table, we think the economy will grow below potential. Priya joins us now. Priya, great to see you. Thank you for being here with us for the full hour.
Morning. Thanks for having me.
So let's talk about the real economy and what the ramifications of this type of uncertainty is. And we're not just talking about uncertainty with respect to the Musk-Trump drama, but also with trade, also with the economy. What are you looking for to understand just how much has been a hit to growth?
Sure. So I think I'm glad you bring up uncertainty because, you know, as the markets have all rebounded, I think the markets wanted to, the equity market, risk assets have wanted to rally because they've said, well, we're not going into recession. But think about business uncertainty. Once you sort of, you know, try and remove the noise, which I know it's hard these days, and look at what is the underlying, we still don't know the trade deals. I mean, we're in that 90-day pause. We have a month left. We have one trade deal. So I think people don't know what that effective tariff rate is. We're all making assumptions. We're in the 10, 15% effective tariff rate. But if I'm a business, I don't know it. I'm frozen into inaction. Do I also cut hiring? Maybe I don't fire people because I remember how hard it was to hire people after the pandemic. But do I, you know, cut back hiring? Do I just wait on CapEx? So there's trade policy uncertainty. There's also fiscal uncertainty. We have the OBBB, which is not, the BBB is not the US government rating, I should clarify, but that's what we're all calling this bill. We have that bill, and we don't know the contours of that bill. Deregulation is another one. So I think with all of this uncertainty, we're in this wait and see. I know the Fed is also in this wait and see, but the longer it lasts and more broad-based it is, I worry that there's a non-linearity, meaning we can handle a month or two of uncertainty. If this is what Secretary Besson calls strategic uncertainty, it's going to live with us for a while, and then people pull back. Oh, remember all the talk of R star is going to be higher? Maybe R star is lower because we all cut back and wait. We don't do much. I mean, as investors, we have to trade this market. But I'm thinking from a business standpoint, this is not the time you do a big ticket CapEx plan. That's what we're seeing in the small business survey, that those CapEx plans are coming down. That's what I worry is going to filter through into the labor market, into spending.
I remember Mohamed El-Erian coming on this show and saying there are very binary outcomes, and it could be very good or it could be very bad. And people didn't seem to be pricing in the very good. And this was at the beginning of the year, that there could be some sort of rebalancing and growth and even reduction in the deficit, that could have been a pathway that this policy mix could have led to. As the uncertainty grinds on, from your perspective, do you think that upside tail risk has been taken down?
I really struggle with that upside tail risk. I can see it from productivity. I can see it from technology. But even there, it requires investments. It requires clarity of what the future will look like. I mean, we're not even sure I think the rest of the world doesn't know, are we their friend or their enemy? I think that becomes an issue for a debtor nation like the US that actually needs the rest of the world to buy not just our treasuries, but our corporate bonds, our mortgages, our equities. So I think there's also, while we're trying to reset trade relationships, we're trying to figure out what are we doing with the debt. There's also this question of the rest of the world financing our consumption, financing our investment. I think that's why I struggle with the upside risk. I look at the one big beautiful bill and, I see a small fiscal stimulus in the next year or two, and then actually I see a drag. So unlike previous big increases in deficits, they were typically growth enhancing. This is just taking the tail risk of taxes going up. I think this is basically taking that off the table. I think the scenario of outcomes is really, hopefully, we muddle through. That's the hope trade, that we grow below potential, but we don't go into a recession, or that non-linearity I talked about, where businesses just say, we're just going to hold off, and we're going to start to cut costs as they're, if we're going to have a 15% tariff, that's a tax on the corporate sector or the consumer. Some of the recent Fed studies are suggesting most companies are passing on these costs to consumers. So now the question will be, can consumers take that? Well, if average hourly earnings, we're going to get that reading very soon. Today, if earnings don't grow, then as a consumer, I may have to pay higher prices for some things. I'm going to cut back on other things. And as consumers make those tough decisions, you'll see that then feed through into the corporate sector. That'll also have to say, okay, where do we cut back? Because we're seeing that destruction in demand. We haven't seen it. We're in this wait and see period. But I think the patience of the economy is running thin. And I don't know if we'll see it today or we'll see it next month. But I think that hard data is going to start to soften in line with what the soft data suggests.
It certainly feels like we're treading water at the moment. If the market could have clarity on these multitude of uncertainties, which one do you think it would be?
I think trade deals would really help, because at least then we get to know that we can, how much do you have to rework supply chains? I mean, a lot of companies, not just manufacturing, service companies, do need that trade, need to understand where can we ship from. So I think trade would help. I think fiscal would help, particularly as we head into the debt ceiling. But that July 4 deadline, it's great if we get it done by then. That's sort of a man-made deadline. I think by early August, by the debt ceiling, we do want that done, or a backup plan. I can understand why they're not talking about a backup plan, but we need something to pass the debt ceiling. So I would put trade number one, this idea that we are not decoupling from the world. We may be trying to ring-fence China on a few strategic issues, but we can still work with the rest of the world. I think that would really help.
I'm glad you said trade, because Nikkei has some new reporting today that in the meeting with Japanese negotiators, at one point they had to stop because Scott Bessent, Jameson Greer, and Howard Lutnick started fighting amongst themselves in front of the Japanese. When you hear and read stories like that, do you think we're actually going to get deals by July 9th?
I'm hopeful we get some agreement in principle. I actually think the market is pricing that in. I don't see any market that's pricing in continued uncertainty or a rolling 90-day extension, which keeps this uncertainty high. There's some talk, but so I'm hoping we get. But there's so many issues. You're right from the currency to the rest of the world buying our assets, to trade deals, to technology. And, is there an attempt to try and get China to rebalance? There's so many goals to revenue raising. We haven't brought that up, but there's that hope as well. So I'm hoping that we get some agreement in principle so that we can have clarity on what is the tariff rate with Japan. I don't know if we're going to get that with everyone, though.
In the meantime, maybe if we want to end on a positive note, because this has been sort of gloomy, we have seen a bid into the 30-year Treasury, which you called a risk asset. Isn't that positive?
It is a risk asset, which tells you that it can move around a lot, and which is why you have to price in more risk premium. But yes, the positive for bonds came about because we got some slightly weaker economic data. ADP and the president posted about it. So that tells you that there's concern. I mean, I think the bond market is pricing in stagflation, which is a fair pricing in given tariffs, and this fiscal issue, and is really not pricing in weaker growth. So what I'm concerned today is, you get slightly weak numbers, anything below 100. I think the bond market, including the long end, is going to say, okay, maybe this was all resting on a solid labor market, and it's not that solid. And then I think you will see rates fall. The steepener may not work because everybody has the steepener on for the fiscal reason. But this is why I would say being long duration and the steepener might be a structural view on, the fiscal trajectory, the fact that the rest of the world might want to get paid more to give us money for 30 years. But the front end, you should be long that because the asymmetry really comes from the economic data. If any weakness, I think that front end has a lot of room to fall.
Priya Misra of JPMorgan will be sticking with us throughout the hour. Right now, let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Yahaira Anna and Yahaira.
Hi, Lisa. President Trump is open to lowering the SALT cap below $40,000 in his big, beautiful bill. Sources telling us here at Bloomberg that the president shared this new openness in a meeting with Senate Finance Committee Republicans earlier this week. Meanwhile, a check on Broadcom shares, those are falling 2.3% in the pre-market. The company, which supplies chips to companies like Apple and Alphabet, gave a revenue forecast for the current quarter that failed to impress investors. The outlook signaling that expectations for Broadcom's AI-fueled growth run were way too aggressive. And in other Musk news, albeit more positive, his company Starlink has received regulatory approval in India, making room for the company to roll out its satellite internet services in the world's most populous nation. The approval is a major step for Starlink after a years-long wait. It has signed deals with local wireless operators to assist with the rollout. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahaira. Up next, Trump and Xi talk it out.
I think we're in very good shape with China and the trade deal. We have a deal with China, as you know, but we were straightening out some of the points, having to do mostly with rare earth, magnets, and some other things.
Coming up next, we'll be speaking with Tyler Kendall. Don't miss that. This is Bloomberg Surveillance. putting together all of the narratives and what people in markets are seeing is some positivity after a week of tumult, eking out gains for the week, up about 0.4%, pretty much across the board for the S&P, NASDAQ, and Russell 2000, a bid into bonds as people look to possibly disappointments in economic data and a real question mark going forward about what the nature of trade will be like between the world's two biggest economies. Under surveillance this morning, Trump and Xi talk it out.
I think we're in very good shape with China and the trade deal. We have a deal with China, as you know, but we were straightening out some of the points, having to do mostly with rare earth, magnets, and some other things. He invited me to China, and I invited him here. We've both accepted. So I'll be going there with the First Lady at a certain point, and he'll be coming here, hopefully, with the First Lady of China.
Here's the latest. President Trump and Chinese leader Xi agreeing to further talks after Trump says the relationship got, quote, a little off track. Bloomberg's Tyler Kendall joins us now. Tyler, what do we know going forward about the path ahead?
Yeah, hey, Lisa. Well, there's still a lot of key details that need to be worked out, but our analysts here at Bloomberg say that by taking the call now, Xi Jinping may be betting that he could get some tangible wins going forward. The thing is, there's still just so much that needs to be addressed when it comes to some of these key trade matters. Now, you heard President Trump there suggest that they did address one of those sticking points for the U.S. when it comes to rare earth minerals. As you well know, the U.S. has been accusing Beijing of slow-walking critical and rare earth mineral exports to the U.S. that are essential to supply chains here. But it's not totally clear on what they agreed to exactly, though it's a sure thing the U.S. would like to see China speed up these export licenses. It's also not totally clear on what Xi Jinping ended up getting out of this call, though in the Oval Office, President Trump did say that all Chinese students would be welcomed in the U.S. This has been a really big concern of Beijing, we know, going into this call amid the State Department's plans to revoke certain Chinese student visas. So we're going to have to watch how this ultimately evolves. And Lisa, it's always a good reminder of the context that it ended up taking 18 months to reach that first Phase 1 China trade deal under the first Trump administration. But negotiators this time only gave themselves a 90-day reprieve to work this out from mid-May.
Tyler Kendall, definitely an ambitious timeline. Thank you so much. Joining us now is Everett Eissenstat, former National Economic Council Deputy Director. Everett, thank you so much for being with us. I want to start by how important yesterday was to you and what you took away from that phone call.
Yeah, it's a very important phone call. It had been quite some time since the two leaders had spoken. And since that time, we had a little bit of a reprieve in Geneva with some settlement of the outstanding bilateral irritants, but it had really started to deteriorate again. So I think the call is very welcome and hopefully sets us on a path for good, solid, sustained engagement.
Who do you think has the leverage right now in this relationship?
It's not all clear to me. I mean, each party has different things they bring to the table. Of course, you mentioned one of them, which is the rare earth minerals and the magnets, which are a very, very important part of the supply chain. But what it does show is that each party has the ability to inflict pain on the other, that there are elements of our economic relationship that we can't just wish away, and that we need to find a pathway to work together. And so the call is a good help. It'll start, we hope, a long and hopefully fruitful negotiation. But yeah, there's a lot on both sides that can be done where it could deteriorate much worse than it has already.
Is this basically both sides agreeing the strategy of mutually assured destruction that potentially they want to avoid?
I don't know if I don't know if there had ever been really this sense of mutually assured destruction. I think it's more a sense.
It seems like we lost the former NEC Deputy Director Everett Eissenstat, but he's talking going forward about the path ahead and what this means for potentially some sort of off-ramp that could be sustainable.
He was there during Trump 1, so he understands how this negotiation works, the fact that Phase 1 trade deal took 18 months, as Tyler just mentioned, and how long this potentially will take. And the fact of the matter is, this isn't just a purchase agreement. There is a number of complexities involved with this agreement, like student visas. That was something that it seemed that the United States was willing to potentially be a little bit more lenient on with just days ago saying they're revoking this. So there's a number of different contours. What I would say, though, is that the two biggest choke points are also the red lines for Beijing and for Washington?
That was exactly my question. That would have been my question to him. What are the red lines? Is it immigration? Is it national security? Is it, trade? Is it technology? Remember those chips export curbs? How important are all of these issues to both sides? Because in order to get an agreement, a good agreement, neither side's going to get everything they want. I mean, you're talking about the world's largest manufacturing superpower and the world's largest consumer. So they're going to have to give in on some things. What are the red lines? And I guess we'll have to live this through as they talk. But I think I don't see how in the next 2 months we're going to get agreement on all of these issues, because it's not just one thing that we're debating.
And how it trickles into the fundamental data that we keep getting. There was ultimately a fissure between any sort of trade for an entire month during the initial salvos of this trade war between the U.S. and China. Now you're seeing ships come in. You see those sort of shipments and exports picking back up. But has there been permanent damage that is going to both increase the costs for consumers and also increase the risks for individual companies that are dealing with supply chain risks and inventory buildup?
Exactly. I think, there's definitely damage that's being done. People are having to rethink supply chains. If you're trying to invest in a new product, well, first, let's figure out your existing product supply chains. Is that happening? So, and I think the question is going to be, you're paying higher tariffs. If it's 30% from China, 10 from the rest of the world. And remember, we're still going to potentially get sectoral tariffs. We're still waiting for that. So the cost is going up. It's being paid by the importer. Now, who actually bears it? Is it the corporate sector or the consumer? I think that's what we're going to have to see it play out in the data. And at the same time, I think the economy was sort of slowing coming into this shock. And now we've created this, I would say it's a supply shock. Let's see if it translates into a demand shock.
And right now, we had a survey recently from the American Chamber of Commerce, and they're talking about the fact that 90% of companies are saying they're not leaving China, even though you see these high tariff barriers the Trump administration put in place. And at the same time, the Trump administration is trying to get a deal done with China. They're also working with dozens of other countries because it is a trade war with China, but it's tariff negotiations and discussions with all these other countries that they want to wrap up by July 9th, which I think is incredibly challenging. We have the Nikkei saying that the top 3 negotiators argued amongst themselves in front of the negotiators. And I just got back from Switzerland where the top trade negotiator told me that even though they are so far along in their discussions with Washington, even they were told if we're not there by July 9th, there will be wiggle room, there will be an extension. So we're going to be treading water this entire summer, and what kind of damage is that going to do to the real economy?
It goes to what the ISM Manufacturing Survey and Services Surveys seem to show, and the Services Survey in particular had one commentary from one sector saying this was akin to COVID-level types of shocks with the supply chain. This is what they saw then, and this is yet again the same type of disruption. How do you determine, and this is something that we've been discussing a lot, what is idiosyncratic and an execution risk when it comes to specific companies versus something broader and an economic risk as you parse through those earnings?
And I think the issue is things will slow down, but is that normalizing to some 1% growth, or is it going to continue? And because this is policy induced, I think the hope in the market is, whether you call it taco trade or, the art of the deal, that policy will rein it back. But to your point, some damage has been done, and I think there is an ideology here in the White House. There's an ideology and there's a pragmatic part, and the market's trying to figure out how ideological versus deal making is happening. But that uncertainty I'm going to highlight, there's an impact. At some point, people just step back and you continue to, do the bare minimum, but that's not what the economy needs to grow above potential.
Priya Misra of JPMorgan will be sticking with us. Up next, President Trump and Elon Musk's bad breakup. Bloomberg's Ed Ludlow joins us next as we parse through what the real ramifications are for the company, aside from the drama, whether this does make a material impact for some of Elon Musk's companies. This is Bloomberg Surveillance. Trying to reach that bull market, still trying to reach some sort of new record high. You see equity markets trying to climb their way into the open. We do see gains pretty much across the board, up about 0.4%. Meanwhile, you do see a bid into bond markets, a sense that maybe there is all calm in Washington, D.C. 2 hours away from the cash open, here are your morning movers with Yahira Anand. Yahira.
Hi, Lisa. We start with Tesla. Shares are higher now, 4.2%, as signs emerge that tensions between Elon Musk and President Trump are cooling after their very public spat yesterday, which we all witnessed. In a series of posts on X, though, Musk seemingly open to de-escalating. We also have that reporting from Politico that White House aides have set up a call with Musk to try and defuse the situation. But as you guys said earlier, best, this feels like a high school breakup. Next up, we have shares of Circle. Those are now higher 11%, climbing again today, extending their gains from yesterday after a blockbuster IPO that saw their shares surge 168%. That is the strongest first day gain since 2021 among larger U.S. IPOs. And it also comes amid an upswing in the IPO market. We've seen companies like Hinge Health and eToro go public, so the IPO market showing signs of life. And last up, we have a check on Lululemon shares. Those are still cratering, down 21% after it issued another weak quarter and a gloomy forecast because it says tariffs will hit profitability. And if you thought your Lululemon leggings couldn't get any more expensive, well, they plan to raise prices in order to offset those tariffs, which could backfire, of course, since U.S. shoppers are already pulling back at their stores. And no, Lisa, I am not willing to pay $200 for a pair of leggings. Back to you.
Duly noted, Yahira. Thank you. I think a lot of other people are also questioning that, which is part of some of the caution. On our radar this morning, President Trump and Chinese President Xi agreeing to hold more trade talks after a 90-minute call yesterday. Trump saying the leaders are, quote, straightening things out in discussions over rare earth minerals. A question about how much optimism markets can really take away from this.
What I find interesting, though, is that the Chinese readout didn't talk about the rare earth minerals and the fact that there's the easing of controls, but the White House did. And this was something that they wanted to take away as a massive win. Another thing that I think was really interesting is Howard Lutnick is now part of the trade team, and he will be joining Jamieson Greer, USTR ambassador, and the Treasury Secretary Scott Bessent for the next meeting. We don't know where that's going to be. Maybe Switzerland, because that's where they had success when it comes to the Geneva Agreement. But him being at the table now begs the question, is this optimistic if you're a semiconductor company like NVIDIA and you want to get access to Beijing and the Chinese market? Or actually, is it going to be hawkish? Is he going to be the individual at the table that says, no, we're not going as far? And the issue, of course, for China, this is their red line. This is the access they want.
I just want to understand, what are the red lines on both sides and what are the ultimate goals on both sides for what this relationship does look like? And this has to do with U.S. and China, and it has to do with trade partners around the world. Nippon Steel and U.S. Steel are on pace to finalize their $14.1 billion merger ahead of a June 18th deadline. The deal would give Nippon Steel ownership of the historic U.S. company, while it retains some measures of American control. The big about face, the deal that will never die, seems to be, at least for now, headed towards some sort of closure.
Right, and they only have a few weeks to go. So you're hoping that if this deal is going to happen, it needs to be done in the next few weeks. I know there's a lot of concern among investors whether or not the CFIUS panel would greenlight this in time. It looks like potentially that's going to be the case. I think we're still waiting to hear a little bit more about exactly what does this U.S. share, this golden share in the company actually look like in terms of the board members. We know it's going to be headquartered in Pittsburgh. These were huge wins for the president. But just taking a step back, what a complete 180. The fact that we're talking about this deal about to be over the finish line this month in just a few weeks is pretty incredible, given the fact that President Trump and President Biden, when he was president, both vowed to not see this deal go through.
Look, there was a lot of hair on this deal. It's hard to use this as some sort of broader question mark around the M&A picture in the United States. This was unique. It had a lot of issues. That said, there is a question about whether there is going to be a softening in some of the mergers and acquisitions that we had expected earlier this year. This was going to be the year of the deal, and we hadn't seen it yet. And Priya, I'm wondering from your perspective how instrumental that type of activity will be to signal risk on, to signal that maybe the ramifications on growth really aren't as significant given the uncertainty that you're talking about?
Sure. So I think it'll help a lot if we start to see deals. Now, why have deals pulled back? Uncertainty, the equity pullback, but also interest rates. This is why I really hope the bond market has a seat at the table when President Xi and President Trump speak. I hope the bond market has a seat at the table when Congress is thinking about this one big, beautiful bill. Because here's the issue. Interest rates have risen, but they've risen led by term premium. They've risen by the led by the long end. Most people, including companies, borrow at the long end. Households borrow at the long end. Most mortgage rates are longer term. So when those long rates rise, then it signals, and it's all being led by the long end. That's why the curve is steepening. I think that's an issue. That's signaling to the rest of the world, we have to pay more for treasury debt. Well, then you have to pay more for that merger and acquisition as well. So I think M&A activity does depend on that long end. The valuation for the long end is getting interesting. The catalyst, not so clear. We have a deficit trajectory. We don't know if the rest of the world is still going to keep buying our treasuries at the same rate. So I think we do need some stability in that long end, and I really hope that everyone's watching. I know you watch the 10-year. I hope everybody in the world is watching that 10-year, and I think yes, if you do see some stability in the 10-year, lower rates, and I'm not sure the Fed can help there. You actually need it from all of these other factors that are driving that long end higher. I think then you get that M&A, and that's a good sign.
Yeah, and that's something that people are looking for some confidence. Meanwhile, as Yahaira has been talking about, Lululemon shares are plunging in the pre-market. The athleisure maker posting disappointing results for the second straight quarter. Lulu saying it might have to raise prices on some items because of Trump's tariffs, and this has been an ongoing question about how much to pass on to the consumer and how much to really absorb in terms of margins. Elon Musk signaling he's ready to cool tensions with President Trump after their feud reached a boiling point on social media yesterday.
I'm very disappointed in Elon. I've helped Elon a lot. Elon and I had a great relationship. I don't know if we're well anymore. People leave my administration and they love us. And then at some point they miss it so badly, and some of them actually become hostile. I don't know what it is. It's sort of Trump derangement syndrome, I guess they call it.
Meanwhile, right now, Bloomberg's Kayla Gardner joins us. Kayla, what do we know in terms of who's talking to who and what kind of ramifications there have been already, both on the White House side as well as Elon Musk?
Well, we can report now that the White House does not have plans to speak to Elon Musk at this time, and no call has already been made between the White House or Elon Musk. And that comes after Politico reported that such a meeting would take place today. And they also interviewed Donald Trump late last night, where he sounded very nonchalant about the debate that we saw amongst them on social media yesterday. But for many people in Washington, this is something that many people expected. A moment would happen that these two leaders would come to a head. Two people with huge egos. You had the most powerful man in the world when it comes to politics, and also the richest man in the world, up until this point, really seeming to kind of break from those expectations, despite some of the negative associations with Doge and some of the inaccurate firings and people who've had to be hired back. They've really survived what has been a tense sort of relationship thus far, and yesterday we saw all of that break down.
Kayla, how are members of Congress dealing with this blow up?
Well, for the president, his attention has really turned to this big, beautiful bill, which has so many huge accomplishments for him that he has touted on the campaign trail and that he really wants to see get over the finish line, whether it's immigration reform, extending tax cuts, energy reform. And that is where his attention is this morning. He's already posted on Truth Social twice talking about his favorability numbers. One message he posted simply said groceries and energy. So that is certainly where his attention is focused today. And Speaker Mike Johnson has also been calling Elon Musk a friend and saying that policy differences should not be personal.
Bloomberg's Kayla Gardner, thank you so much for being with us. Joining us now is Bloomberg's Ed Ludlow. Ed, I am curious about how important this is as a broader takeaway when it comes to the trajectory for Elon Musk's portfolio companies. We talk about this as this ongoing drama, but it's really important to remember there is a lot of money at stake here. This company, Tesla, lost more than $150 billion of market capitalization yesterday, just in one day on the heels of this fallout.
Yeah, I mean, like, the stock's up 5% in pre-market, right? Why is that? Is it because it's Friday at the end of a long week and everyone just wants to have a bit of relief and get back some of the 14% drop from Thursday? Or is it literally that a detente or burying the hatchet between the administration and Elon Musk is driving thesis? And what I find so interesting about this, and I spoke to a lot of people in the last 24 hours that are not just Tesla shareholders, but on the private side, SpaceX shareholders as well, right, is that a component of the Trump trade, particularly prior to November, was simple, that it was a friendship between Elon Musk and President Trump that would allow Elon Musk to have the ear of the president, and so therefore influence policy in a way that would be to the benefit of Tesla, in particular in the long run, and keep SpaceX closely aligned, particularly to the defense apparatus of this country. And that, we can go over the reporting of the last 10 days or so, but I think that's particularly true in the case of robotaxi, right? Because the stock has been volatile on any reporting or signal that Elon can or cannot get some kind of federal level oversight of robotaxi, which would help Tesla in the long run in that field.
Ed, we spoke to Speaker Johnson yesterday about what was going on between Elon Musk attacking this bill. And here's what he had to say by potentially the reasons behind it.
Sure. I'll let everybody draw their own conclusions about Elon's motivations. I'll tell you that, I mean, obviously the EV mandate going away is I'm sure, a concern for, the leader of Tesla.
Ed, if you look at what Elon Musk has said in the past about EVs, July of last year, take away the subsidies will only help Tesla. December, I think we should get rid of all credits. And then yesterday, he said keep the EV solar incentives cut in the bill, but also cut everything else. Is this really the crux of the issue, what led to the blow up between him and the president of the United States?
Well, and I believe that the president of the United States also cited, the EV mandate issue in a cabinet meeting in March. And AMH, correct me if I'm wrong, the cabinet meeting in March, which was on camera, he basically said, Elon's never asked me for a thing. I told him I'm going to cut the EV subsidies, which, and I think the president said, I don't know how that would impact Tesla, I'm assuming negatively. But Elon Musk has been consistent about that. His basic argument, which you're right, started next summer and went all the way through to present day, including the election and the outcome of the election, is that he doesn't need the he doesn't need the EV incentives or subsidies because he feels like Tesla, because of its critical mass and scale, will benefit and lead the market anyway. And that those subsidies would hand a greater advantage to others who are not as profitable as Tesla on EVs and things like that. So it's an interesting domain. But again, so is space, right? And the use of the threat of Dragon capsule being decommissioned and then reversing that threat, that there are some fractious points of contention in policy.
Ed, are there any shareholders who are upset by this, who are calling for Elon Musk to take a breather and maybe take a step back from the public spotlight in terms of his political involvement?
Yeah, loads. My phone's been going off for,
but that's
12
important,
hours.
right? I mean, ultimately, he does ultimately have a fiduciary responsibility to people. What do they want to say?
I don't mean that flippantly. It's why I brought up the robotaxi thesis, right? So what we reported last Friday is that at the end of last week, Elon Musk and all of his staffers that have some kind of responsibility in DC were phoning up lawmakers to try and influence the content of a bill that is passing through Congress on autonomous driving legislation, right? That is the complete center of the long-term bull thesis. I think Dan Ives was on the network this morning, right, saying that the events of the last 24 hours have not changed the long-term outlook for Tesla. But that's the only question of why we are reporting and discussing a fallout between Elon Musk and the president, because all of that long-term thesis was predicated on the idea that Elon Musk's proximity to the White House would result in policy and legislation that acted favorably in the long term for Tesla, particularly in the field of robotaxi, which is less regulated. And I can tell you that other leaders in that field that compete with Tesla are deeply worried that Musk will do that he will affect some legislation that has a disproportionate boost to Tesla relative to others in the fields that Tesla plays in.
Yeah. Ed Ludlow of Bloomberg, thank you so much for getting up early and talking with us about this morning. It is fascinating, and it raises a question: what was actually behind Elon Musk's dissent from this big, beautiful bill? And Priya, it remains to be a question: was it the EV credits or was it something else?
I think there was an aspect of the deficit ideology as well. Remember, Elon Musk, I mean, apart from Tesla, he was in charge of Doge. And he tried to do a lot. Now, we can debate, he didn't get his trillion, he got probably 100 billion or so in terms of cuts, but he worked, he was part of Doge. It was right after the inauguration, we had Doge. So I think some of this is, as he's looking at this one big beautiful bill, seeing that really the tax cuts are temporary, which means they're going to get extended. A lot of the spending cuts are backloaded, which means they may not happen. So even the CBO estimate of 2.4 trillion deficit impact, it's likely to be closer to 4 or 5 trillion. That's before the Senate has come in. So is Musk trying to highlight the deficit issue again? I know the market's focused on trade and then deficit, and so he's trying to probably get us back into, we have an unsustainable deficit trajectory. But I'll say one thing, I mean, I've been doing this a long time. We've been talking about the deficit trajectory since 2001, that it's unsustainable, that we have an entitlement problem. Why now? Why is the concern now? Because we're in a strong economy. This is when the deficit to GDP should be lower. There doesn't seem to be any political will to do that. Yeah. And the other big issue is the interest service cost. So if you're paying 4.5% for debt and nominal GDP is 3%, now you've got a problem. So we do need, Secretary Bessent talks about this pro-growth. We kind of need to believe that growth will be higher than that interest servicing. And I think the market's losing patience with it.
Talking about growth, coming up next, we'll talk about payrolls. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Anna and Yahira.
Hi, Lisa. President Trump and Canadian Prime Minister Mark Carney have had direct talks about a trade deal. The U.S. has import taxes on Canadian-made steel, aluminum, and autos, and Canada has retaliatory tariffs on American-made goods. Trump is planning to attend the G7 summit in Ottawa on June 15th, and some Canadian officials are hoping to reach a deal before then. Meanwhile, BlackRock is planning its second round of job cuts this year, eliminating about 300 people months after a similar move at the beginning of 2025. It comes after the world's largest asset manager splurged on $28 billion worth of deals to wade deeper into private markets, and that, of course, added to its headcount. And David Beckham is set to be knighted next week. That's according to The Sun. The knighthood comes over 2 decades after Beckham was appointed an Order of the British Empire for his contributions to football and charity. Beckham is an ambassador for UNICEF and the King's Foundation, focusing on education and the environment. His wife, Victoria, will be known as Lady Beckham after the formal announcement. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Up next, counting you down to payrolls.
I think the market gets worried if you get something below 100,000. I think over 200,000, maybe you get a bit more optimism. But for now, you know, there's a very tight range of estimates.
Sarah Wolfe of Morgan Stanley joins us next. This is Bloomberg Surveillance. A lot of drama, but in the bond markets, in the stock markets, not so much. In fact, we're ending the week with gains heading into the open, building on some earlier gains. Russell 2000 in particular up 0.5%, NASDAQ up 0.4%, as well as the S&P. We are in payrolls Friday, despite what it might feel like. Under surveillance this morning, counting down to payrolls.
We're at 160. I think the market gets worried if you get something below 100,000. I think over 200,000, maybe you get a bit more optimism. But for now, you know, there's a very tight range of estimates. And we're thinking about what we're seeing in hiring trends, going from about 177,000 the previous month to 160 makes sense in our view.
Here's the latest, less than an hour away from the May payrolls report. The estimate in our survey, 126,000 jobs added. Sarah Wolfe of Morgan Stanley falls in line with consensus, expecting exactly bang on the dot 125,000, with unemployment unchanged at 4.2%. Sarah joins us now for more. Sarah, great to speak with you. Thank you for being here. What do you think is going to be the most informative aspect of this report, given the mess that everyone keeps talking about and potential distortions?
I do think that the Fed is going to be looking still at the unemployment rate. And the reason they're going to be more focused on the unemployment rate than the payroll number is because break evens are coming down. So naturally, we're going to be seeing slower job growth with slower immigration. So break evens are probably somewhere around 120,000 right now. That is going to fall even further to about 90,000 in the back half of this year because of slower immigration. And so really the Fed wants to be able to gauge the labor market tightness, which is going to take into account payrolls and supply. And that's what's going to be reflected in the unemployment rate, which we're expecting, and consensus is expecting to stay at 4.2%.
Sarah, how do you see the rise in the claims data? Over the last 2 weeks, it's picked up. Do you think this is seasonal, or this is indicating that businesses are finally starting to let go of some people?
I think that the claims data is reflecting exactly what we're hearing from businesses, that it's a softer hiring environment. Businesses cannot think ahead because they don't know how trade policy is going to shake out. They don't know the final details of the tax bill. And so they're putting off big investments like CapEx and like hiring. And then they're also starting to shed some workers. And I wouldn't be surprised if the first place we start to see some of this weakness and layoffs, we've already seen it in federal employment, but I expect now to start to see it in leisure and hospitality. You have to remember that the employment report looks to add 400 to 500,000 jobs in leisure and hospitality across May and June to ramp up for the summer travel season. We know that summer travel is likely going to be softer this year, not only because travel inbound from overseas to the U.S. is down double digits year over year, but also because there is this concern among consumers across the income distribution about their finances, and so they're likely going to travel less this summer.
So, it sounds like you're looking for the labor market to weaken and I guess lower numbers going forward. The Fed has this dual mandate. I'm curious your thoughts on inflation, given that we are living in a 15-20% effective tariff rate. Are you seeing signs that businesses are passing these prices along? I mean, in 2018, I remember we had the washing machine tariffs, but dryer prices went up. Do you think businesses will be able to pass it on? And then how do you think consumers react?
Well, this is really the million-dollar question: is can businesses pass through 80% of prices through to consumers, which would be a best-case scenario, or 30%, which is going to make it much harder for businesses. I think in this type of environment, we're definitely seeing some price pass-through, but we have to remember that consumers are quite price-sensitive right now. They just went through 5 years of extremely elevated inflation. Consumers are very attuned to tariff risk and what it's going to mean for prices because we've seen inflation expectations accelerate. We also, in our own consumer surveys, found that over 50% of consumers pulled forward purchases ahead of tariffs, showing that they are price sensitive and they're trying to get ahead of the tariffs. And so as a result, I do think it's going to be difficult for businesses to fully pass through pricing. That doesn't mean we're not going to see inflation, but it might put a little bit of a cap on how much inflation acceleration we do see.
Sarah Wolfe of Morgan Stanley, thank you so much for that. And that's something that we've seen ongoing, this question of how much is it going to hit margins and how much is it going to hit the consumer, given the fact that there is this pushback.
But when are we going to actually see it in the hard data? And is today potentially the first time we could see a crack? But as everyone will tell you, one bad data report is not going to be enough for the Fed to really start bringing up rate cuts. They're going to need to see a trend, 2, 3, 4.
And there also is a question about whether we end up with a lower headline payrolls number that's just the new normal based on immigration and demographics. Priya, Misra of JPMorgan, thank you so much for taking the time with us today. Always wonderful to get your insights, and hopefully we'll have you on soon. Coming up for the next hour, we do get that payrolls report. Stuart Kaiser of Citigroup, Michael Collins of PGIM Fixed Income, Stephanie Roth of Wolfe Research, and Jeff Rosenberg of BlackRock, as we're expecting 126,000 jobs created with a steady unemployment rate. This is Bloomberg.
The labor market's in a bit of a holding pattern.
Demand for labor has actually slowed quite significantly.
The estimates are rather tight. There's a very tight range of estimates.
If we see any type of weakness in the labor market, that's what the Fed is going to be looking at.
It's the labor market that matters most.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome back to what we can now call Payrolls Friday, expecting a modest slowdown in job creation as companies slow hiring. Getting the latest read on the economy amidst ongoing trade uncertainty, and economic data seems to be trying to claw back the spotlight from the drama that has been unfolding on multiple screens in Washington, D.C.
Good luck to that economic data trying to claw back some of that center stage, because actually what we're hearing now is that there's not going to be this call between the White House and Musk. So potentially we are going to see that implosion continue into a second day. When it comes to the economic data, what I've been wanting to know is what is the number that would actually distract people to care about the economic data and not the implosion of Elon Musk and President Trump. And it seems to be so far under 80,000 or north of 150,000.
We can pose that question to our guest host for the hour, Stephanie Roth, chief economist at Wolfe Research. What is that number that would get the markets to pay attention?
You know, I think even if it's 100,000 or below, I think you start to claw back that attention. And then I think on the upside, sure, 150 or so would certainly do it. But the number sub 100, I think, will get people a little bit uncomfortable. Even though we should expect the trend growth in payrolls to slow down throughout the course of the summer, it's just noticeable when it starts to play out.
There is a big question underpinning all of the back and forth of the turmoil that we have seen, which is at what point does it really affect the long-term outlook that investors are trying to cling to, as opposed to getting whipsawed by all of these headlines? Do we have a sense that, as Priya Misra was just talking about, that the long-running uncertainty is having ramifications that we are starting to see in data that for a hot second turned into a positive surprise on the trend, but seems to have really waned over the past couple of days?
Well, now we're starting to get the May data, and May is the period of time where we had the peak uncertainty. As we move throughout the next couple of months, I think that uncertainty will start to wane when it actually gets reflected in the economic releases. But now we're living through the actual economic data that played out during that period of time. So we're going to feel it in the next 4 weeks.
And Annmarie, you've just kept pointing out that all of these trade negotiations are going to take quite a bit of time. And it's not like we're going to get some sort of resolution. And some of the tariffs have already started to be implemented. And you're starting to see the ramifications of that trickle through.
Right. And when it comes to the two biggest economies, they're now going to be on a path of negotiations that are going to take months. When it comes to Beijing and Washington, we saw that yesterday with this phone call between President Xi and President Trump. For all the other trade negotiations, reading the tea leaves, they're just not done yet. I just got back from Switzerland. They're very far ahead, but they've been given assurances that if they're not there by July 9th, there will be some sort of extension. This is a country of 9 million people. If you can't get a deal done with Switzerland pretty quickly, then what does this mean for Japan, for India, for Vietnam, for Korea? This is going to be challenging, and the timeline is very, very tight.
Maybe it's all priced in. Right now in markets, you're seeing equities higher, futures higher ahead of the opening bell and ahead of that key payrolls print. We're seeing across the board up 0.5% in the S&P and NASDAQ, 0.6 on the Russell 2000, climbing into the open. A sense of a bid into the bond market, maybe giving some comfort to those worried about the deficit. We have seen a massive rally in the 30-year yield this week, down 10 basis points just in one day. Continuing that this morning, 4.87%, pretty much range-bound across the board elsewhere. And then what you can see for the payrolls expectation coming up, 126,000 in the Bloomberg Economic Survey versus 177,000 in the previous one. Steady unemployment rate at 4.2%. Watch the space. That is what a lot of people say is the important indicator. Coming up this hour, Stuart Kaiser of Citi as stocks look to rebound after snapping a three-day rally. Mike Collins of PGIM Fixed Income on rising expectations for an economic slowdown. And Jeff Rosenberg of BlackRock reacting to payrolls. We begin this hour with stocks higher ahead of the May payrolls report. Stuart Kaiser of Citi writing positive trends in economic data. We'll get a test with payrolls, but we expect data to get a hall pass this month given tariff uncertainty and the FOMC in wait-and-see mode. Stuart joins us now for more. Stuart, a very kind way of saying they just don't matter and people are going to ignore them. Am I correct?
Yeah, I mean, they matter to the extent that they're not, outside of a wide range. And I actually think the downside range is far more important. I'm not sure the market would respond as much to an upside surprise as it would to a downside surprise at this point. But yeah, I mean, the Fed, corporate America, everybody is kind of in this wait and see mode. I think they've sort of bullied or convinced investors that that's the way to go. And likely you won't get a big response out of this. But again, if it's surprising, particularly to the downside, and to your point, particularly in the unemployment rate, I think that's where you get a little more convexity into the system.
What do you think about the risks heading into the back half of this year, though? Is it more about economic uncertainty, or is there a chance that tech earnings or AI kind of disappoints from an equity market perspective?
Yeah, I think the medium-term risk is growth, whether that's GDP or EPS. We can sort of debate which is more important. If you look back to Q1 earnings, most 2/3 of companies punted, and I don't think the market or investors are going to tolerate that in the second and third quarter. So I think if you were to get downside over a medium-term perspective, it's much more about growth. And, again, EPS, GDP, I think it depends on who you're talking to at this point.
We've been talking about this implosion between Elon Musk and President Trump all day. There's one tweet that we haven't talked about yet, and the fact that Musk actually said Trump's tariffs will cause a recession in the second half of the year. Do you agree?
I think it's basically a toss-up at this point. I think most people are 50, somewhere between 30 and 50%, chance of a recession. The recession view, I think, is, hey, they're trying to pull back on fiscal. You've got this massive uncertainty shock, and you've got tariffs.
Does it make you think twice, though? This was someone that, as of a week ago, was in all of these meetings and lurking around the Oval Office?
It matters. I'm not sure how well Elon could forecast economic growth, so I think that would be important to it. But yeah, it does matter that he's an insider and he had sort of been drinking the Kool-Aid and pushing the narrative pretty hard. So it matters, but this is not something new. I think most people expected, again, the combination of fiscal and uncertainty and tariffs to really weigh on what was already a late cycle economy. So, recession risks are elevated. I think that's why you're seeing small cap, for instance, not perform well, low quality stocks not perform well. And I mean, this is the medium-term risk. Near-term, it's tariffs and interest rates, and medium-term, it's a growth story.
I'm going to trigger you, so just a trigger warning for Stuart Kaiser. There is a feeling that maybe bad news is going to be good news. I can see you already rolling your eyes. That if you get some sort of softer economic print that actually causes a rally into the bond market, which could potentially be stimulative, and talk about Fed rate cuts, and we have seen that kind of behavior over the past couple of days. Do you reject that outright, or do you see that as actually having staying power? Since I know you love that phrase and really believe in it.
I think if the issue on yields was at the 10-year point, maybe we could have this discussion. But if you're getting weaker economic data, that's not really going to help. That shouldn't really help the 30-year point as much as it would move the 10-year point. But you know me, I'm good news is good news. So I think if you're rooting for softer economic data because you want rates lower, I just think it's the wrong way to kind of approach markets.
But if you take it a step further, is the rally that you're seeing at the long end, after so many people dismissed it as something of a risk asset, nobody wanted to buy it, the fact that it's rallying, is it on the heels of some negativity that you think that the stock market's not paying attention to?
For me, no. I honestly think what got the 30-year moving is, one, Japan started to talk about, getting the supply-demand balance sort of sorted out a little bit. And you got a lot of comments from Secretary Bessent also trying to calm down that long part of the curve. The risk there is what they have is talk. They don't have a lot of tools to really rein in the long end of the curve unless you're going to get really extreme about things and talk about QE and pulling 20-year auctions. So, I think what happened there was much more about Japan yields kind of coming in and that spillover risk kind of getting reduced a little bit. Our view, I'm not a race guy, so me, 2 years is policy, 10 years is growth, 30 years inflation. I haven't seen a whole lot on the inflation side that would have gotten that 30-year down. The other thing we did see is a lot of real money stepped in once you got a 5 handle on the 30-year. So I think you had a little bit of a step in on the demand side, and then you had Japan sort of signaling a little bit on the supply side as well as Bessent, and that kind of stabilized it.
It's been hard to find a compass in this market. It feels a little bit like head on a swivel, and hard to figure out whether it's the economic data, whether it's what's coming out of Washington, D.C., or whether it's what companies are saying. What is your compass right now, given all of the noise that we're seeing?
Yeah, it's a tough one. I mean, on the tariff side, I would say things are getting faded on the tariff side from a market perspective. I think most people are using tariffs as a little bit of a buy the dip. I think that remains in place unless the China-Trump stuff really kind of goes off the rails. Yields, to your point, I think yields is actually right now the biggest risk to equity markets because we still need to deal with this budget deal. And I don't think the Musk-Trump stuff really helps that. But medium term, to the point earlier, it's really about economic growth. So, look, typically you always have something say, I come in the morning, I look at this, and this will tell me, kind of how equities are going. And right now, I think that's yields, frankly. I think if you come in and you see 30 years stable, you're likely in a grind higher U.S. equity market. If you come in and see that rate vol and those rates kind of really moving, that's probably telling you're maybe having a little bit of a risk-off day. I don't read X as much as the average person, so that's a little off to the side.
We're sitting here at the end of the year. The market's up 15% from here. What was the main driver of it, and what are the catalysts that got us there?
The main driver is, I think, pretty simple. We get some sort of progress on the tariffs. The markets have been very tolerant to a lack of concrete tariff progress, I think. And the second would just we just don't go into recession. I mean, what we get there is corporate America kind of punted, tariff stuff eased. We sort of avert a recession, and we get some sort of, I don't want to say certainty, some sort of clarity, let's call it that way, on the tariff side. I mean, this is... You came into the year, you had 15% EPS growth kind of priced in. That's got revised lower. If we get a stability in earnings, I think we can kind of be okay on that side of it. And we haven't even talked about budget tax negotiations.
But does it concern you that consensus is basically looking at the fact that trade policy will be wrapped up by July 9th?
Yeah, I don't know if there is a consensus on trade policy. You talk to smarter people on trade policy than I do, but
in the market, they basically think that we can move on after this.
That's the hope. I mean, if you look at the performance of stocks exposed to tariff policy, they've kind of round-tripped all their way back. So, yeah, I think there is a fair amount of confidence that at least the tail risks have been trimmed off, and we settle into something that looks like a 10 to 15% effective tariff rate, which I think if we went back to January, 10% was kind of the base case. So we went from
that's
10.
What he campaigned on, yeah.
Yeah, exactly. So I think that's what was kind of priced. Obviously, we way overshot that for 4 to 6 weeks. But I do think the market is settling back into the idea that the number is going to be somewhere between 10 and 15. Therefore, the tail risk has kind of been dealt with. So we can kind of, I don't want to say look past that, but I think there's, at least it's been sort of compartmentalized. It's going to be sort of in this range. It's over on this side, and I can kind of focus on other things.
I'm looking at dartboards, and maybe we should purchase one to spruce up the decorations here on the Bloomberg Surveillance set. Stuart Kaiser of Citi, thank you so much for being with us. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg brief with Yahaira Anand. Yahaira.
Hi, Lisa. Elon Musk has signaled he's ready to cool tensions with President Trump after their very public feud yesterday on social media. Politico had reported the White House had a call scheduled with Musk today to defuse the situation, but sources telling us here at Bloomberg there is no call scheduled. Meanwhile, Tom Cruise has earned a Guinness World Record for a stunt in his latest Mission Impossible movie. Cruise now holds the title for, quote, the most burning parachute jumps by an individual, with the total count coming in at 16. The editor-in-chief of Guinness World Records said in a statement, it's an honor to be able to recognize his utter fearlessness. That is awesome. And on to another awesome story. The Indiana Pacers won game one of the NBA Finals and did so in dramatic fashion. After falling behind by 15 points in the fourth quarter, Indiana stormed back to bring the game within one possession in the final minute. Pacers star Tyrese Halliburton hit the game-winning shot in the game's final second to stun the Oklahoma City crowd. That's your Bloomberg brief. Lisa?
Thank you so much, Yahaira. Annmarie, are you willing to challenge Tom Cruise's record of 16 times jumping out of a plane?
Incredible. Go watch the entire video. I think I saw it like 15 times yesterday, and now I'm going to see Mission Impossible this weekend.
15 times?
It is incredible that he did this 16 times. It is a parachute on fire. It's unbelievable. I mean, there's no one like him.
Incredible is one word. Up next, the morning calls, plus Mike Collins of PGIM Fixed Income with our final countdown to the May payrolls, which may give us a bit of a sense of what kind of ramifications there are from the tariff effects. This is Bloomberg. Minutes until we get that payrolls number, which might give us a sense of just how much of the economy has really been affected so far by tariffs and trade. Heading into that, you do see a lift to markets, ending the week on a strong note, up about 0.5% on the S&P, on the NASDAQ, a bit into bonds. And what Stuart Kaiser just said is really important. Every morning when he comes, he looks at the bond market to see if there is stability. This morning, there is stability. There was a bid. Now it's flat. Now it's a little up on the front end. But what we're seeing is there has been some sort of floor under how far the 30-year bond price can fall, how high those yields can go. Time now for the morning calls. First up, Goldman Sachs lowering its price target on Tesla to $285, pointing to weak deliveries and consumer survey data across key regions. Next up, Wells Fargo cutting its price target on Lululemon to $270, noting the company's rare cut to its full-year guidance. And finally, Loop Capital downgrading McDonald's to hold, citing negative feedback on the company's new chicken strips. Turning now to the economy, May payrolls just moments away. The estimate in our survey expecting 126,000 jobs added and unemployment to hold steady at 4.2%. Joining us now is Mike Collins of PGIM Fixed Income. Mike, thank you so much for being with us. I want to start on this idea that we have seen some weakness come into the economic data over the past couple of reads, whether it's the manufacturing survey, whether it's the services survey. How much do you expect that to be reflected in today's payrolls number?
Yeah, thank you, Lisa, and good morning, Annmarie. Yeah, we had this dichotomy between the soft data or the survey data and the hard data or the actual data, and now they're starting to normalize, right? You are, as you said, Lisa, starting to see more evidence of the job market in particular slowing, not just the ADP report, but some of the other key leading indicators for jobs like the quits rate. Interestingly, if you look inside that ADP report, Lisa, and you look at small business hiring, it's really fascinating. From 2015 to 19, it was on a downward trend. And then you had the COVID thing. And now it's kind of resuming that trend. So it's really been on almost a 10-year downward trend, which is very natural when an economy like ours matures. When the demographics really start to become a headwind, that natural rate, as you were talking about earlier on your program today, of employment, the natural rate of job gains just comes down, from the 200s to the 100s, and presumably over the next year or so below 100,000. So part of what we're seeing is kind of just a natural maturation of the cycle. But of course, the immigration debate and the trends there are certainly worrisome for the job market.
So, Mike, let's say we see this trend growth in payrolls run 50 to 75,000 as the economy continues to mature, as immigration starts to slow down, but the unemployment rate starts to edge lower. What does the Fed do in that environment? How do they balance out the combination of a low, steady state payrolls growth with unemployment rate that's falling?
Yeah, that's a dynamic we've really been contemplating recently, Annmarie, right? If you have less labor, if the labor force is really shrinking, the unemployment rate might remain really sticky. And that is a little bit of a conundrum for the Fed. Obviously, they're looking at full employment. But if you have less people and it hurts GDP and growth is really falling, they certainly have to weigh that. But if the job market continues to be strong or in balance like it is today, it's going to be really difficult for them to move, right? And obviously on the inflation side, it could take, a quarter or two or three to really see this tariff impact on prices. Obviously, you're getting big pushback, as you see in some of the corporate reports today, on higher end spending. I mean, who the heck can afford $150 Lululemon T-shirt, right, in this economy? But that is going to continue. So the Fed is really on hold. I mean, it's really hard to see them do anything through the end of the year unless you get a big change in the job market, which doesn't seem to be in the cards, or the inflation rate continuing to come down, which probably is unlikely.
Okay, I want to get your take, though, on this unofficial poll I've been doing all day, because everyone still seems to be distracted by the implosion of Elon Musk and Donald Trump. What is the number that then potentially the news cycle can move on to either a really great standout jobs number or a really low number?
I don't know, the standard deviation, the band of confidence, Annmarie, around these employment numbers is gigantic. The revisions are gigantic, right? The ADP and the NFP payroll divergence is gigantic. And then you have seasonal trends. So I don't know. I mean, it's got to be, I think, significantly below 100 to see a big move down in rates, and significantly, above 150 to see a big move up in rates. But it's really, you have to look at these numbers over the long term. The long term is much clearer, that we are on a declining trend in job growth, right? And that really is important. And it shows that we're going to be on a declining trend in real GDP growth. And we're moving from a world of 2.5% to 3% GDP, which we've really enjoyed since the pandemic, to one where we're going to probably be between 0 and 2 for the next few years. And let's hope, we stay above 1.
What do you make, though, of continuing jobless claims continuing to nudge higher? Does that give you pause and concern about today's number?
So way back in the day, decades ago, Annmarie, when I was a young quant modeling interest rates, the moving average of the unemployment claims and the continuing claims was actually one of the few decent leading indicators for interest rates, meaning as that number continues to creep higher on a consistent trend basis, it generally points to a slowing in the economy, which generally leads to rates falling, right? So I know there's a lot of panic about the fiscal situation in the U.S., the gigantic amount of supply we have, term premiums going up in the U.S., curves steepening in the U.S. and globally. But you know what? What really matters is growth and inflation, and if the growth side globally and in the U.S. is flagging, that will certainly put a ceiling on global interest rates, on U.S. interest rates, on real rates. So I'm sticking to our guns here. Anything 4.5% to 5% on the 10-year Treasury is the real oversold buy zone. 4 to 4.5, where we're in the area right now, and we're at the high end of that, is still I think over the longer term, a relatively attractive entry point for interest rates.
I'm glad you went there because you talk about global rates, and rates should get a bid if there is slowing growth. What are we talking about? Is it 2 years and 10 years? Is it also 30-year yields, considering some of the questions around what actually is driving that particular trade?
Yeah, I mean, the curve will steepen, right, in that kind of recessionary, significant slowdown scenario, like it always does. I mean, the curves have steepened a lot already in the U.S. We're 100 basis points, twos bonds, which isn't steep historically. And so, yeah, you could make the case, Lisa, that, if right now there are 100 basis points of Fed rate cuts priced in for the rest of our lives, right? That's it. And it all happens in the next 12 to 18 months. And then, the forward curves are really, really steep, meaning rates are poised to go up basically back to 4%, from 3 3/8 over the next, 5-10 years. And part of that is just maybe term premium. But, it's, the bonds are cheap here, and 5-year would fall. That's typically to 5 and 7 years, the fulcrum point where you want to be involved, you want to have some duration in that point to hedge your equity risk.
Just really quickly here, Mike, a couple months ago when we had Liberation Day, or less than 2 months ago, you came on and said the world has changed. Is the world the same that it always has been, and some of these correlations actually are going right back to where they were before?
Yeah, I mean, I'm not a big believer in the correlations changing. I mean, we've looked at correlations between stocks and bonds for centuries, Lisa, and it's zero, right? And the only time they're positively correlated are when you have inflation going up, which we had in 2021, 22, and that's why you had that big sell-off in stocks and a sell-off in bonds. That has happened in past periods when inflation goes up. The other time the correlations change is in a recession. Yeah. And in those environments, the correlations almost always go negative, meaning bonds rally when stocks sell off. So that ballast to your portfolio that fixed income provides actually works in a recession, and I firmly believe that will be the case if we have a big global recession.
Mike Collins of PGIM Fixed Income, thank you. We are just about 5 minutes away from the May payrolls report. Coming up, BlackRock's Jeff Rosenberg and Bloomberg's Ira Jersey are here, of course. Stephanie Roth of Wolfe Research also alongside us, which is a wonderful thing. As we parse through those numbers, the expectation is for 126,000. "25 seconds away from that May payrolls report. Heading into it, we see a lift across the board in equity markets, up about 0.5% on the S&P, still about 3% away from all-time highs. If you look at the bond market, we did see a bid earlier this morning. It has faded as there is a grind higher at the front end, 3.94%. If you bleed it through, you do see a bit of dollar strength. Right now, we are looking at the May payrolls report just crossing. Michael McKee, Bloomberg Economics and Policy correspondent. what's the latest?
Well, I feel like Kevin Bacon in Animal House. Everything's fine. Nothing to see here. 139,000 jobs created. The expectation was 126. We do see a revision down to the numbers for April to 147,000 from 177,000. So the weakening trend continues, but we're not falling off a cliff, as ADP might have suggested. 4.2% for your unemployment rate out to one digit. We'll check on the three-digit numbers. Change in private payrolls, 140,000. That is 20,000 more than what was expected. The net revision over 2 months down by 95,000. Labor force participation rate is a little bit lower, 62.4%, and the U6 7.8%. Average hourly earnings strong, up 0.4, which pushes the year-over-year rate up to 3.9% from 3.8%. So stronger, maybe a little inflationary numbers on that side. No change in weekly hours, 34.3. I'll look into the rest of the numbers, Lisa, and get back with you in just a second.
What you can see is not really a whole lot of drama, but you do see in the bond market a lift across the board. Michael McKee, stay close. We're seeing in the two-year space in particular up now 5 basis points to 3.97%. That two-year yield definitely getting a lift when you take a look at stocks. It does turn out that good news is good news, holding on to those gains as we do see those estimates come in above expectations. That said, the revisions taking notice, given the fact that there was a downward revision from 177,000 in April to 147,000. Nonetheless, all of this viewed more broadly as confirming that there is nothing falling apart. Stephanie Roth of Wolfe Research is still with us. Stephanie, your take on what we're looking at right here.
I think the thing to remember is this is a period of time that was kind of peak uncertainty for the economy, given the tariff headwinds. So now looking ahead, we should anticipate that payroll gains are going to remain fairly solid throughout the course of this year. Now, they're going to slow down given the immigration trend, but we shouldn't expect an environment where the unemployment rate is rising significantly and we're in a real layoff situation. We should expect a steady slowdown in the pace of hiring just because immigration is going to be a big headwind, but the economy is going to be largely okay.
What kind of impact will immigration have?
Pretty significant. So, by the way, this is not getting enough attention, but last week the Supreme Court ruled that they can terminate 530,000 visas for people from Cuba, Haiti, Nicaragua, Venezuela, effectively overnight. So this is likely going to show up over the next couple of months as companies really realize they have to check visas. But we're going to see a notable headwind, bringing the steady state trend in payrolls growth below 100,000. But what we're learning today is that might be in an underlying economy that's still fine.
And what does that do to the unemployment rate?
It brings it down by a couple of tenths.
So how challenging is that for the Fed to cut?
They can. It's going to be a difficult one. If we're in an environment where steady state payrolls growth is running, call it 80,000, and the unemployment rate is steady to lower, and by the way, inflation is running at close to 3%, they can't do anything. They're going to have to just sit and wait it out. And why would they if the economy is just running kind of fine and the inflation is still, risk of certainly running notably above their target?
There's a real question about how much the actual employment rate and the payrolls figure is a leading indicator or a lagging indicator. There has been a belief that companies will hold on before firing employees for a much longer period of time, especially since the pandemic. At what point is this the last thing that's going to fall apart as we see other ramifications to the economy and other sectors?
Yes, we need to keep an eye on profit margins. And the idea here is effectively how much costs can these companies push through when it comes to tariffs. So if we're in an environment where consumer inflation is actually running close to that 3%, in a way that could be an okay thing because that means you're not really feeling the burden from a company perspective. Consumers can probably handle a little bit of goods inflation and they're not going to have to do layoffs because companies are able to pass through a lot of that cost.
And this ultimately goes down to the question for the Fed as well. If you do have companies that are absorbing more of it and not passing along the cost as much, it also would be more disinflationary or less inflationary than otherwise, and it would give them the ability to cut rates into what is, by all other measures, a softening market. So at what point is that going to be the base case at a time where you're looking at 2 rate cuts still fully priced into the market by the end of this year?
Yeah, I'm surprised that the market is still looking for 2 cuts at this point. It's probably just sort of the average of all outcomes, right? There's still the chance that the economy tips into recession as a result. I would say if you survey a lot of investors, they're expecting, call it 1 to 2 cuts. But I think the direction of travel here will be in an environment where the Fed and the market are going to start to price in 0 cuts for this year. Maybe towards the back half of 2026, they can cut 1 or 2 more times, but we're sort of running out of time here.
Why is that, given the fact that the economy clearly is weakening according to a lot of different metrics?
Well, it's weakening because we got hit over the head with a tariff headwind and a ton of uncertainty. But now the uncertainty is likely to fade to some extent. Now we understand this whole taco concept, which is silly, but it's true that Trump doesn't seem to want to intentionally tip the economy into recession, so companies can feel better about investing in this environment. They know there's less likely of a chance that the economy actually goes south, in which case, all right, my business is doing okay, now I just have to continue to invest and grow.
Our intrepid economics correspondent has been parsing over the data. Stephanie Roth of Wolfe Research sticking with us. Michael McKee, what do you see as you parse through the data?
Well, intrepidly looking through the data, we see that basically it's as kind of forecast. Manufacturing jobs were down by 8,000. Primary metals, we checked that out. The steel mills, 1,300 additional jobs. And fabricated metals, same number, so no impact from tariffs there. Construction up by 4. Retail jobs fell off by 6,500. Warehouses and couriers, people were looking at that because of the idea of pulling forward orders, and we do see slight increases in the couriers, 6,500, a drop of 5,100 in warehousing. Government, though, interesting number from the federal government, down 22,000. Of course, we have to double check and make sure that's not the U.S. Postal Service, which it mostly is, but federal government except the Postal Service down 15.8. thousand. So we're starting to see some Doge cuts there. The 3-digit unemployment rates, 4.244. That is up a little bit from 4.187, but not worth even worrying about at this point. The reason it looks like unemployment not changed very much is the number of employed falls by 696,000. The number of unemployed rises by only 71,000, but the labor force falls by 625,000. That may be the story of this report. As immigration gets halted at the border, the labor force, if that continues to shrink, will hold down any changes in the unemployment rate for a while.
Yeah, to Stephanie Roth's point, the idea of just generally lower numbers as the immigration trends really shift. Michael McKee, thank you as always. Joining us now is Jeff Rosenberg of BlackRock. Jeff, we take a look at this report. Nothing to see here. Markets are taking it in stride, albeit with a little bit of a lift at the front end of the yield curve. What's your big takeaway as you do see numbers tempering, but not exactly falling off a cliff?
Yeah, I think the big takeaway is slowing, but still a strong labor market. And I think that's why you're seeing a little bit of the bond market reaction here, pricing out a bit of that expectations in terms of the Fed. But it's pretty close to expectations, a little bit on the high side. I think the wage number is kind of the most interesting thing. It doesn't seem to be affected by the wage week. So, this is part of the strength coming into it. But I smiled when you asked the question to Stephanie, what is really the forward-looking outlook here for labor markets? There'll come a point where we'll talk about labor markets and this labor market report, and it will be validating a trend that we may be concerned about. And that will be told to us first by what's going on with profit margins. Absolutely agree with that point. It's really the pausing point that we're at here with this market report, not really moving us either confirming the concerns that we had a month and a half ago around a recession, or validating the response in financial markets that, the peak of uncertainty is over. I think we're still in that uncertainty environment, and the data still that we need to validate whether or not which way that economy is going to go is still in front of us. So this is a little bit backward looking and lagging to answer your earlier question to Stephanie.
So, Jeff, let's say we're sitting here in a couple of months and, maybe payrolls growth are still slowing, but holding in somewhat okay. What would be the driving factor? Is it the reconciliation bill? Is it that tariffs are having less of an impact? What's the upside story to the economy here?
Yeah, and I think it's what you were highlighting before about whether or not this is the peak uncertainty is behind us, and its impact on decision making is not as great as we might have feared in the middle of April. And so I think that's really the determination: is what impact does all this uncertainty, which I think we still have. We haven't resolved a lot of that uncertainty. We could debate that point, but really it comes down to not what do we think about the uncertainty, but what do we do about the uncertainty? Do we press ahead and just make decisions, make investments, hiring, as if nothing had happened? Or is there a cooling effect on all of those decisions, whether they're on the business side or on the consumption side? That's what's going to drive that economy. It's going to drive the consumption side in terms of demand, and it's going to drive business confidence in terms of what we see in terms of investment. And that's, I think, what the narrative is going to be 2, 3, 4 months from now.
Well, do you think the business community will just keep treading water? How do you make those decisions? I mean, just moments ago, Peter Navarro, a trade aide to President Trump, is telling reporters that the China meet is expected in 7 days. So in a week's time, we could be dealt with a fresh blow of uncertainty, Jeff.
Yeah, I think the honest answer is we just don't know, because the new data that's coming out, whether it's the challenges from the legal perspective, whether it's the change in terms of the negotiations, what is actually in those negotiations in terms of how much they relieve the uncertainty, we just don't know. And I think there is a cooling effect in the interim. It doesn't show up because the data is still lagged, so it'll show up in the next couple of months. So I just think we don't quite know on the trade impact.
Given the lag, do you think then the Fed is going to be behind the curve? I mean, Elon Musk, an insider who's now on the outs, was saying yesterday that Trump's tariffs will mean a recession in the second half of the year.
You know, I think the Fed has been very clear in their communications that the headline is wait and see, and that the economy is in a good enough position where they can adopt that approach. I think if there's one thing to this report today, it kind of validates that approach, right? We're not seeing an aggressive move in terms of the slowdown impact in hiring in the economy. We're not seeing a huge acceleration. I do think there's some strength, some lingering strength there in wages, but not enough to really press on the inflationary concerns. And so the Fed's in a good spot here to wait and see. Will they be lagged? Yes, this is kind of the, impact of moving from forecast dependence to data dependence, is that the Fed has to be reactive. And so they'll be lagged. The issue for the markets will be, will they aggressively catch up if they are indeed, behind the curve in the event that the trade and tariff uncertainty, leads to a bigger slowdown? Then they're going to have to get more aggressive. That's not priced in to the bond market, as we were talking about. It's only 1 to 2 cuts because it's not yet showing up in the data.
I want to take a step back and talk about what you and Stephanie both brought up, that this labor market information isn't necessarily going to be as tradable as some of the earnings data that we get with respect to profit margins. And I wonder if there's something of a paradigm shift where we were so data dependent, and every economic indicator that came out for the past couple of years was a huge tradable moment that was going to give some sort of insight into what the Fed would do. Is that era over? And are we now earnings dependent? Not necessarily when it comes to figuring out how much money they're making, but what companies are doing with what we're hearing about in the mess in real time in a way that this data cannot tell us anymore, Jeff.
Yeah, there's a long history to the payroll report in terms of moving the bond market. Has it lost some of its efficacy? Certainly, we've come out of this period where inflation has been the bigger driver. Clearly, that has been the story over the last couple of years. And so the payroll report isn't really the kind of preeminent data release on inflation. It has an important component with regards to wages and wage inflation, as I was just highlighting. When you think about kind of the demand side shocks that we typically associate with recessions, the payroll report can be, more confirmative on those trends. And solidify the expectations for the Fed. That's where the linkages and the importance to the bond market comes from. But when the issues are more supply side, and we can kind of think of tariffs and the tariff shock as more of a supply side, it has both elements of a supply side and demand side. But when you think about economic shocks driving financial markets that are more from the supply side, yes, the labor markets kind of lose their primacy of being kind of the preeminent data release that we focus on.
Jeff Rosenberg of BlackRock, thank you as always for being with us and giving us some insight, pointing to that key metric coming out of the report that the May average hourly earnings rose 3.9% year over year. Stephanie, versus the expectation of 3.7%, even with a work week that stayed steady.
Yeah, I mean, this is an environment where the labor market is holding up okay. We should expect wage inflation to run around 4%. Throughout the course of this year, we might actually see wage inflation run a little bit above 4% as we see a real tightening in the blue-collar labor market. So this could be the start to a trend where we start to see a bit of a tightening, even though the headline jobs numbers are, notably are starting to move below 100,000. This could be a really complicated backdrop from the labor market perspective, and we're just going to have to get used to it.
To parse the complications, Ira Jersey of Bloomberg Intelligence joins us now. Ira, there is a feeling that the Fed is permanently on hold, and you are seeing a reaction in bond markets that reflects that. Do you think that this was an unabashedly positive report that would fuel ideas of maybe the Fed needs to push back their next rate cut?
Well, we've been thinking that the Fed was going to cut not until the fourth quarter at the earliest this year, and because of exactly what you just said, Lisa, which is that the job market is fine, right? So if you think about the two mandates that the Federal Reserve has, we haven't yet seen a significant uptick in inflation because of tariffs, which may be coming and might not be. But at the same time, the labor market hasn't cracked. So unless you wind up seeing a significantly weaker labor market, which would mean sub 100,000 payroll prints plus slower wage growth. Like you just noted, we have aggregate labor income. So when you take those weekly earnings numbers, add to that the growth of the number of people with jobs, that's running at 5% year on year. That's nowhere near recessionary levels. So unless you see a significant slowing in the jobs numbers over the next couple of months, the Fed's probably not going to cut until November or December at the earliest.
We did see revisions, though, for the prior 2 months. Does that concern you at all?
Concerns a little bit, because that is the type of thing that happens toward late in the cycle or early in a cycle where you wind up seeing revisions either downward like we just did or upward if you're coming out of a recession. But when you take all the averages and you look, we're still running over 100,000 payroll growth, which is above the replacement rate for the labor force. So as long as we're running above the replacement rate of the labor force, the job market seems relatively tight. And as important or more important, or at least as important, I should say, is those wage data, right? And when you have hourly earnings growing at 3.9% year on year, and you have a 0.4% month on month growth, that's fine, right? That's showing that the economy and the labor market is still reasonably tight, and you'll continue to have spending growth. So top line numbers for a lot of companies, for example, might still be okay. Now, bottom line might wind up contracting because of the tariffs, but at least from a revenue side, the consumer still has money to spend.
And that is the ultimate question. And Ira, before we let you go, there is a question about if consumers are still getting paid more and their wages are going up, does this mean that it's not just a one-time price shock, but that potentially in response to increased costs from tariffs and other supply chain potential inefficiencies, that companies could continue to raise prices into the future, that longer-term inflation that really is one key question?
Well, that's very likely. And one of the reasons why you've continued to see inflation, particularly in the services sector, which really has been driving inflation over the last 2 years, is the wage input to those prices. And with wages growing at 3-ish plus percent, then businesses need to pass that along. And that's one reason why I think you've continued to see the service sector contribute so heavily to inflation and inflation gains over the last couple of years. So, this is the same as we've seen basically for the last 18 months, and doesn't seem like it's slowing very significantly yet anyway.
Ira Jersey of Bloomberg Intelligence, thank you so much for being with us this morning. Right now, let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Yahira Anand. Yahira.
Hi, Lisa. Recapping that jobs report, May payrolls topped forecasts with the U.S. adding 139,000 jobs, while the unemployment rate held steady at 4.2%. Data for the prior 2 months were revised downward by a total of 95,000 jobs, signaling employers are cautious about growth prospects as they weigh the Trump administration's economic policies. Meanwhile, President Trump and China's leader Xi Jinping have agreed to further trade talks aimed at resolving their disputes over tariffs and supplies of rare earth minerals. The two spoke yesterday by phone for 90 minutes. Senior U.S. trade advisor Peter Navarro spoke to reporters just a few minutes ago and said the talks would happen within the next 7 days. And four-time NFL MVP Aaron Rodgers is heading to Pittsburgh. The free agent quarterback agreed to a one-year deal with the Steelers, ending months of uncertainty around the future of his career. The 41-year-old is coming off 2 seasons with the Jets, who the Steelers will face in week 1 of the upcoming season. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira, for this morning. Have a wonderful weekend. Up next, setting you up for the week ahead, this is Bloomberg Surveillance. This morning, good news is good news in equity markets, building on gains from earlier after a payrolls report that beat expectations. We did see right now across the board up about 0.8% on the NASDAQ, S&P, Russell flying up more than 1.2%, counting down to the opening bell, 1:30 p.m. Eastern. President Trump signs executive orders. Monday, Apple's Worldwide Developers Conference. Wednesday, we get CPI. Thursday, PPI and another round of jobless claims. Plus, Tesla's robotaxi launch in Texas, which has new focus on it. Stephanie Roth of Wolfe Research, thank you so much for being with us for the hour. What's your takeaway from this payrolls report?
Yeah, I mean, the data was fine. It tells us the labor market, the fundamentals are pretty solid. And by the way, this was the month that should have generated the most uncertainty from an employment perspective. Now, the expectation is Trump's not going to intentionally cause a recession as a result of his tariffs. That said, our medium-term outlook is the economy should be fine. And the risk to growth next year is that we could actually see above-trend growth in 2026 as the reconciliation bill starts to hit and the impact moves from tariff headwind to reconciliation bill tailwind. That said, over the summer, we might be facing some risk for markets. So we have labor data that might not look as rosy as today just because immigration will have a headwind. There's going to be seasonal factors. The tariff negotiations are going to start heating up. Bond yields, may be volatile as we talk about reconciliation bill and then concerns around data. So in the near term, market risks are a little bit elevated, even though over the medium term, the economy should be fairly solid.
Stephanie Roth, thank you so much for spending time with us this morning. Stephanie Roth of Wolfe Research, Thank you. And Annmarie, you had this quiz. It didn't meet it. It was not a number that really superseded all the other drama.
The number was kind of boring for the drama. The drama's heating up, and I'm sure everyone will be distracted again today by Elon Musk and President Trump. But the most important headline to come out this hour was that Peter Navarro says within the next 7 days, you're going to have the Chinese and U.S. delegations sitting down. To Stephanie's point, you have the heating up of these trade negotiations, and potentially we could see more of the parameters of what a deal could look like between these two economies.
We'll carry that conversation forward. Coming up on Monday, Keith Lerner of Truist, Abby Yoder of JPMorgan, Wei Li of BlackRock, and Vinu Krishna of Barclays. But first, coming up at 9:30 a.m. Eastern, Annmarie will get to the White House's reaction to the payrolls report from Secretary Lori Chavez de Remer. Don't miss that as they discuss the road ahead. This is Bloomberg.